City, I'm Shauna Smith alongside Brad Smith. This is the debut of Yahoo Finance's new flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you the day's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. This new show will break down Yahoo Finance's trending tickers and bring you the biggest stories of the day with expert analysis to help you form your best strategy for that portfolio. So let's lay out your roadmap for the day and get right to it with the three things that you need to watch for your portfolio this morning. Alexis Keenan, Jared Blickery, and Brian Sazi around the newsroom with more.
Boeing once again under scrutiny for its 737 MAX jets. The jetliner's MAX 9 planes are being grounded until the FAA deems them safe to fly. This comes following an incident on Friday where a side panel was blown out in mid-air on an Alaskan Airlines flight from Portland, Oregon to Ontario, California. Boeing shares are tumbling in the pre-market. We'll break down what Boeing's legal troubles could mean for investors long term.
And futures searching for direction this morning after a rough start to 2024. The Dow, S&P 500, they are both posting their worst start to a year since the year 2016. And another cautious note out on Apple this morning could put more pressure on the broader markets. Jefferies warning that Apple's sales slump in China getting worse. And this comes after two analysts downgraded the stock over growing concerns from the iPhone maker's next smartphone sales. But investors are eager to get a read on inflation with Thursday's CPI print and the start of a new earnings cycle. Fourth quarter earnings season will kick off with heavy hitters JP Morgan, Wells Fargo, Bank of America, Citi, and BlackRock this Friday.
And congressional leaders agreed on a $1.6 trillion spending deal. This comes as the House and Senate inch closer to a crucial January 19th deadline when funding runs out for many federal agencies. Funding for the rest of the government expires on February 2nd.
Let's get started with our top story this morning here. Shares of Boeing, they are tumbling. The company's MAX 9 planes, those 737 MAX 9 planes being grounded until the FAA deems them safe to fly. This is following an incident on Friday where a side panel was blown out mid-air on an Alaskan Airlines flight from Portland, Oregon to Ontario, California. A small section of the plane's fuselage blew out at 16,000 feet. There were no deaths, and the flight was able to return safely to Portland. The National Transportation Safety Board has since found the panel in the backyard of an Oregon teacher's home. We have extensive coverage on this story, and Jared Blickery is in the newsroom. Alexis Keenan here at the desk with us, and later we'll speak to Ronald Epstein, who is the Bank of America Senior Aerospace and Defense Analyst. Let's start with our own Jared Blickery on the sell-off in Boeing and the major airlines this morning. Jared.
Yeah, let's go straight to the Wi-Fi Interactive, where I am tracking general weakness in the aerospace industry. And you can see the background are the quotes from Friday. So Boeing, which was up 1.66%, is down 7.59% in early market. And that is a stark contrast from its competitor, which is Air.PA Airbus. That is up in European trading. It's trading over in Paris about 2% to the upside here. But one of Boeing's biggest suppliers here, Spirit Aerosystems, which gets about 60 to 70% of their revenue from Boeing, that is tracking a 14% loss in the pre-market. And just taking a look at the 5-year price chart here, we can see echoes of what happened before when the 737 MAX system was under and putting pressure on those companies. So just taking a look at Boeing, same time span, you can see we are up against resistance here, but with a 7.63% decline that's being projected for the early trading, probably not going to breach that to the upside today.
All right, thanks so much, Jared. We want to kick it over to Alexis Keenan. She's here at the desk for us. And Alexis, when we bring up these issues that have plagued Boeing now for some time, bring us up to speed at exactly what the last couple of years have looked like for this company.
Yeah, so, you go back to 2018, late 2018, early 2019, when we had the crashes of Lion Air and Ethiopian Air. And those, obviously, a major headache for Boeing. Boeing still paying out settlements, entering in deferred prosecution agreements with the Justice Department, billions of dollars at stake here. But let's talk about exactly what happened over the weekend and why this is so critical for Boeing here. The NTSB now investigating this accident over the weekend in a press conference. The director saying that this would have been a violent and chaotic experience for all the passengers and crew on board. There were only minor injuries, miraculously, noting that the two seats that were adjacent to this door plug is what it's called at 16,000 feet being blown out of the aircraft. 171 passengers, no one getting any more than a minor injury, 6 crews, and the FAA then has grounded the plane on Saturday after that Friday incident. Now, this is the MAX 9 plane. This is specifically not the MAX 8 that was involved in those 2 crashes that killed 350 people approximately. This is one of 4 jets in Boeing's MAX family, the MAX 7, 8, 9, and 10. 2 of those in the air. The other 2, the MAX 7 and the MAX 10, still awaiting certification from the FAA.
All right, Alexa, thanks so much for breaking that down. Let's talk about the reaction that we're seeing for Boeing today, because Boeing now facing more regulatory scrutiny as its Alaska Airlines incident comes just a week after the aerospace giant warning its customers about potential loose bolts in some of its 737 MAX jets. Now, despite all of this, the street overall remaining bullish on the stock, 26 buy ratings compared to just 6 holds and no sells. Our next guest is one of the analysts keeping his buy rating on the stock, along with his price target of $275 a share. We want to bring in Ronald Epstein. He's Bank of America's senior aerospace and defense analyst. Ronald, it's great to have you here. So a big sell-off that we're looking at ahead of the open for Boeing, yet you're still bullish on the name. Why?
Yeah, so a couple things to think about. I mean, investors can immediately jump to conclusions about whose fault was what. If you listen to the NTSB report last night and the previous NTSB reports, it's not clear who did what in this. Clearly, the plug got blown out of the airplane. Could have been Boeing's fault. Could have been Spirit Aerosystems' fault, who's the supplier for it. Could have been the manufacturer of the door plug. Spirit doesn't make the door plug. So we'll see. So it's very, very easy for investors to jump to conclusions. But why remain bullish here? We're in the midst of a huge, unprecedented, in fact, aerospace ramp-up post-COVID downturn. And there's only 2 suppliers of large commercial jets of note. That's Boeing and Airbus. Like you mentioned in the broadcast, that the 737 MAX 9 is just one of the family. The MAX 8 is the most volume member of the family. They sell a lot of MAX 8s. So from a financial perspective, longer term, this will be a bump in the road, albeit it doesn't lessen the shock of what happened. They'll get to the root cause. They'll get this behind them, and they'll deliver airplanes into this civil upcycle.
Ron, when we think back to what took place during the MCAS system and the grounding that ensued thereafter, after those 2 deadly and fatal crashes here, we saw $25 billion of Boeing market cap wiped off of this stock. If you think to now what is potentially coming forward in many other regulatory bodies around the world having to look across the 737 lineup and this particular part of the MAX, where could this potentially impact the market cap, investors trying to understand exactly what type of hit they should be pricing in?
Yeah, so comparing this to what happened with the MCAS system, I think would be a mistake. MCAS and what happened there was not well understood at all. In this case, it's relatively simple. It's a door plug. Door plugs are used across the industry. Airbus uses them. Boeing uses them. Other airplane manufacturers use them. I mean, the real question here is this most likely was a fabrication issue and where that happened. So the read across from MCAS to this would just be wrong, and that's jumping to the wrong conclusion. MCAS was a far more insidious sort of thing because there was not broad understanding about what was happening there, and we could talk about it for hours, so we won't go there. But so I wouldn't do that read across. It's no surprise that the stock's weak today. I mean, there's going to be a reputational hit here. We're seeing that for Boeing and for the airplane. But like I mentioned before, demand for aircraft is as strong as it's ever been. And in fact, we're in a situation for demand for aircraft is outstripping the ability for the industry to supply them for a multitude of reasons. Supply chains are stressed, labor stressed, so on and so forth. So, we're in the midst of this unprecedented civil upcycle, and I think that's where we are. But I would just reiterate, trying to compare the MCAS are 2 very, very different situations. This is a fabrication issue where the MCAS system, and this is the root of it, was an engineering design flaw. My sense is there's probably not an engineering design flaw here. We'll know for sure when the NTSB finishes its investigation, but that's my sense.
Ronald, what about the case that we've heard over the last 24 hours or so, just about the pressure that CEO Dave Calhoun is under right now, whether or not there needs to be a management change at the top level? Do you see any reason to believe that we could see Dave Calhoun forced out because of this?
So that's ultimately a decision for the board. Dave came in as CEO. I mean, he was on the board before he was CEO at a troubled time of the company. It's my sense they've been making some recovery in terms of pushing the company in the right direction. But one of the key questions for Boeing, and the board's going to have to answer this question, does Boeing really need a renewed focus on engineering across the management space? And has the current management team done that? Right. I think the issues we've seen with the aircraft and the multitude of things that's happened even in the defense business over let's call it the last 5 to 8 years really begs the question: should the company be doubling down on its focus on having a very strong engineering culture? And then the board just has to decide, is the current management team the right team to do that?
Ron, our own Alexis Keenan, who you heard from momentarily ago on the legal side of this matter, flagging to us that there had been pressure warnings at least 3 times prior to this taking place. And so this also comes back to the type of training that needs to also be rolled out across any of the different aircrafts, of course, that pilots are being trained on. But that also has a financial impact as well here. And so as you're thinking about that training, that once again being in the throes of the conversation here, what type of kind of financial consideration does that mean for Boeing and for all of the other airlines that they need to make sure that is reinstituted in any type of the aircraft operator's mindset?
Yeah, from what the NTSB said last night, that warning light actually happened when the airplane was on the ground, when there wasn't a pressurization situation. So I'm not an expert on this, but what I can say, I can reiterate what the NTSB said. Alaska Air took the proper precautions. They weren't flying the airplane on very long trips because of that. But there wasn't an immediate worry that there was some sort of pressure leak on the airplane because the warning light went off on the ground. So it suggested that there might have been a failure in the sensing system. And again, I think it's important. It's way too early to jump to conclusions that those warning lights had anything to do with what happened with the plug section in the back, just because of the nature of how the warning lights went. But pilot training and crew training is an important thing, and the industry spends a lot of money on it.
Ronald, going back to what you just said a moment ago when we were talking about the CEO, the pressure that Calhoun is under right now, I know you said it's up to shareholders, the board here, to decide. But from your perspective, you've been closely following this company now for years. Do you think Calhoun is the right person to lead Boeing?
Yeah, like how can I say? Yeah, again, it's the board's decision. It's not what Ron thinks, or the Boeing board and the Boeing shareholders have to make that decision. And I think ultimately it comes back to, has the company's focus on engineering been right? Now, I've been a pretty vocal. Boeing has decided not to do a new airplane until sometime in the 2030s. I've written many times that I think that's a mistake, and that's what the current management team decided to do. I would be more comfortable if the company was pushing its engineering culture more. They seem to be pushing more financial culture. But again, like I said, it's not Ron's view. It's what the board thinks and what shareholders think.
Yeah, well, we'll see exactly where the financial culture that they're pushing perhaps helps put some capital back into that engineering culture that you'd like to see more of. Ronald Epstein, who is the Bank of America Senior Aerospace and Defense Analyst. Ron, thanks so much for taking the time here this morning.
Yeah, my pleasure.
Keep it locked here on Yahoo Finance. We'll get you some more updates on the latest Boeing news as it comes. Also, be sure to check out our website for updates on Boeing stock, ticker symbol BA, and the price action there. Stay tuned here. We also have an FAA licensed commercial pilot, Anthony Roman, with us at 11 a.m. Eastern Time with his take on the situation. Well, keeping things going here, the S&P 500 coming off of its worst starts to the year, since 2016 after a pair of downgrades on Apple spooked investors. And another cautious note out on the tech giant this morning could put more pressure on the broader markets here. Jefferies warns that Apple's sales slump in China is getting worse, with a further decline in volumes likely this year. So does this spell more trouble for the tech sector? We want to bring in John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, great to see you here this morning. So what does the rough start for tech spell out for perhaps the first quarter at least, and especially considering some of the gains that we had come off of last year?
Well, Brad, thanks for having me on the show. First of all, we've got to say when we look at this, we think the overall effect on the market has been one of some profit taking amongst the Magnificent Seven, some concerns related to some names within there. We think it'll get ironed out somewhat in fourth quarter earnings season, which really gets kicked off this week when the big banks start up. But in addition to that, we've seen rotation, rebalancing among the sectors, among style, as well as market capitalizations. And overall, a repricing of the thought about when the Fed is going to begin cutting. So what affects one company's stock here is not really, we think, that where the market goes. We've got to think what we have to define to separate the noise from the signal and consider what is idiosyncratic and what is systemic.
Well, John, taking that under consideration here and your expectations for earnings growth, looking ahead not only to the upcoming quarter when we'll get fourth quarter results, but ahead here to the rest of 2024, do you think earnings season is going to be enough to kind of turn around this momentum that we saw to the downside to start the year?
Oh, we think as we look at the fourth quarter earnings season across the transom, we think we'll see enough surprises that are positive to offset concerns in certain areas, a weakness, whether it is on tough comps, whether it is issues that are tied to global growth or domestic growth, and the considerations by various strategy groups and hedge fund groups within the market. So we look at it, if anything, the Journal over the weekend, as I recall, said that based on what they were seeing from FactSet, growth is now expected to be around 1.3% earnings growth. That would be down from around 4% in the third quarter. But remember, going into these earnings seasons, analysts have been relatively conservative overall, and the sense of the market has always been very negative going in. So open to positive surprises, and we think the economy is bigger than the bare negative pitch book here.
Does that mean traders should be embracing in some cases, but also prepared for some of those more volatile shocks post earnings?
Brad, absolutely. Volatility is part and parcel of the markets and uncertainty. As you know, I've been doing this. I've been involved in the market since 1983, so I've been through every boom, bust, and recovery cycle in the process. And what we've got to say when we look at it is things have to get digested. It's not uncommon after a remarkably powerful run from the end of last October through the end of the year that markets probably got ahead of themselves. And we were looking from that October 27th low of last year for about 6-7% upside, and it was I think about 14-15% upside, and a lot of that was based on expectations or bets rather by market players that the Fed was going to cut 5 or 6 times this year. We don't think that's likely. Inflation remains too sticky. Jerome Powell does not want to have to become Paul Volcker and take draconian efforts against inflation, nor does he want to be Arthur Burns, who was the predecessor of Volcker, who missed the ability to fight inflation. So we think the Fed remains on guard, but still remains very sensitive. And as a result of that, things aren't as bad as they may look in the moment. It looked like a haircut to us more than than a stock route based on where stocks had run.
So, John, for investors out there, for our viewers who want to take action on all this, they're trying to figure out what's the best way to position their portfolio. What's some of the adjustments that they should be making today?
Shauna, I think the big adjustment is to take a look at what you own, know what you own, why you own it, have realistic and right-sized expectations of how different sectors, market capitalizations, and style positions will perform. balance that against where your goals and objectives are, as well as your tolerances risk. And in that, if you are able to take market volatility, the advantage of when some stocks that were too expensive for you last quarter suddenly look cheaper in here because they're babies that get thrown out with the bathwater, there's an opportunity to add positions. We don't suggest just blindly buying the dips, but rather look for those babies that get thrown out with the bathwater. And in the case of ETFs, sometimes they actually throw sectors or thematics out with the bathwater. So it's a good idea to keep alert.
John, just quickly while we have you, when you think about the areas that are perhaps most prone to profit taking ahead of a hard Fed pivot or announcement of any sort of cut coming forward, what would those sectors be?
I think right now, based on the performance of technology and communication services, which as I recall, were both up around 50% last year. Consumer discretionary was up powerfully as well. I think those would likely be areas that would be prone to seeing selling. But I think when you look at that, you've really got to consider the effects of the Fed's actions based on economic data, which shows they've made remarkable progress on inflation while being very sensitive to the effects of practicing their mandate on the economy. Of course, their mandate basically being to strive for stable economic growth and low unemployment, or what they say is full unemployment, which is basically somewhere between 3% and 4% unemployment.
All right, John, always great to get your insight here. Again, target for the S&P, year-end target of 5,200 by the end of 2024. John, great to have you. Look forward to talking with you again soon.
Thanks.
Let's get to the latest on Capitol Hill, because Democrat and Republican leadership have reached a deal on top-line spending numbers for 2024. A congressional leader setting spending for the year at $1.6 trillion, but a possible government shutdown still looms. Yahoo Finance's Rick Newman has the latest on that. And Rick, where do things stand today?
I think this is a happy surprise that there is a deal among the leaders to keep the government funded and keep everything going in Washington. But it's not approved. It's not voted on yet. So we are, in a way, back to where we were last September. And the whole question is whether the new House Speaker, Mike Johnson, who replaced Kevin McCarthy, whether he can get enough Republican votes to pass this, or if in the alternative, if Democrats will provide the votes that the House would need to get this through. So it's the same kind of tension between the House Speaker and the conservatives in the House, the Republican conservatives known as the House Freedom Caucus, who don't like this deal. They don't think it cuts spending by enough. But the question is, will enough of those super conservative Republicans go along with this to get it over the hump and passed and sent up to the White House, or will we see the same sort of drama we saw last year with them, grumbling about the speaker and ultimately trying to fire the speaker? The analysis I'm seeing this morning suggests that the dynamic is a little different this time, mainly because Mike Johnson comes from that conservative wing of the Republican Party, and there's not the kind of personal animosity that existed between those conservatives and Kevin McCarthy. So, the optimal outcome for markets would be that they just pass this thing and we don't have to care about all these dynamics among the Republican Party at war with itself, and we can just get on with knowing that the government is funded. But there's, we're not there yet.
Where does it seem the biggest hang-up will continue to be, Rick?
It's whether the conservative wing will say we can live with these very modest spending cuts, or if they demand more. And then, by the way, this does not include that separate deal that would include the aid for Ukraine that President Biden wants, aid for Israel, and those two things coupled with some kind of immigration deal to tighten up on the migrants coming across the southwest border. So that is not included in this. That would be separate. And I mean, the odds of all of this happening might be about 60%. President Biden said recently that his State of the Union address is going to be scheduled for March 7th. That is a little later than usual. It's usually in February. And that might be so that there's enough breathing room to get the government fully funded and get these things out of the way before Biden goes up to Capitol Hill.
All right, it'll be interesting to see how the funding brouhaha on a cadenced level at this point plays into the 2024 elections as well here. Rick, thanks so much for breaking this down and continuing to monitor the situation.
See you guys.
See ya. Coming up, we've got a busy week on deck here at the Morning Brief. Yahoo Finance Today is live at CES in Las Vegas and JPM's healthcare conference on Wednesday. We have fresh inflation data to bring you live, and then you can't miss Friday, the big kickoff to earnings. We're going to hear from the big banks, plus some more data. We've got you covered on all of it. Catch us live on Yahoo Finance's Morning Brief.
Welcome back to our new show, The Morning Brief, the one-stop source that you can trust.
Yahoo Finance's new flagship show counts you down to the opening bell, tracking early session volume while bringing you the day's top market themes as delivered daily in our most popular newsletter, all with one focus: to help investors make smart decisions during the entire trading day.
Every day, we are going to bring you the big stories with top expert analysis, insight, and actionable advice. This is the ultimate guide to help you make smarter decisions for your portfolios.
Well, during today's market activity and Yahoo Finance's flagship newsletter, also known as the Morning Brief, when it comes to investing in the consumer, pros say stick to what's worked. Consumer spending remained robust in 2023. Inflation finally started cooling and helping Americans spend more to help prop up the economy. So, how should investors play into the shocking resilience of the retail sector? That's the big question this morning. Yahoo Finance's executive editor, Brian Sazi, here with us on set to break it down for us. Hey, Sazi.
Hey, Brad and Sean, good to see you. And I actually got to write the flagship newsletter here, The Morning Brief, so that is always very exciting for me. You can read that on the Yahoo Finance homepage right now. But what got me thinking was that really that stronger than expected, another one I would add, that stronger than expected jobs report that hit on Friday, more than about 216,000 jobs added, really telling me, like Brad mentioned, that the economy remains strong. You're seeing inflation come down, gas prices are down, a lot of good things happening in this economy, and that retail stocks or that some consumer stocks may be good early bets here. So let's run through some of these, some of the ones that pros that are telling me they continue to like. First up is Lululemon. Lululemon really seen as a winner in this market here, and we're seeing it out of the gate this morning, coming out ahead of their ICR presentation in Florida, which our very own Brooke DePalma is at, raising guidance. Company now looking for 14% to 15% sales growth for the fourth quarter, was at 13 to 14%, also taking up the bottom end of their earnings guidance by about 10 cents. So a good news from Lululemon, a brand that continues to work. Along those lines, we have Abercrombie & Fitch, another brand that had a bang-up third quarter. A lot of folks that I talked to expect them to raise guidance at the ICR conference this week on the back of really strong demand from younger people. And then lastly, Costco. Last week, under the radar, Costco came out and probably had one of the best holiday shopping seasons in all of retail. Same-store sales for December up 8.1%. Super, super strong. So you have some of those names that the pros like. Let's go deeper here in terms of analysis. Why choose consumer stocks in this environment? Really three things I think you need to boil it down to here. One, the January, the jobs market surprise, a good thing many people are looking for there. Inflation continues to come down, and really interest rates are likely to continue to fall this year, guys, and that could be a real catalyst to the space.
It could be a real catalyst, and Saz, we have to take a step back, right? Where we are today is pretty shocking considering the predictions that we started 2023 with, even the predictions that we were getting over the last several months with the resumption of student loan payments, with a long list of challenges that face the consumer, yet people are still out there spending. I'm curious, though, from your perspective and the conversations, I guess, that you've been having with some of these retail companies, is it very stock specific or company specific, or do you think we're going to see some of that strength almost across the board?
Well, I'm glad you asked, because I have a couple things here I think investors need to be looking for when picking out some consumer stocks. It's not just retail, it is restaurants. A lot of restaurants are doing very well, a lot of cruise lines. First up, stick with what works. Lululemon has been putting up strong results for over 2 years, and we are seeing a reaffirmation of that with the company's guidance raised this morning. So stick with brands that work, companies that are kicking butt. Don't look around for turnaround stories. Number two, experiences. I think if we've learned anything about the consumer over the past year, consumers are willing to pay up for experiences. Cruise vacation, you name it, a trip out to Dave & Buster's, whatever the case is, those are what people are paying for, so you want to try to invest in that, pros are telling me. And last but not least, stick with companies that have a clue on how to deliver great customer experiences online. Those are the likes of a Walmart and Target, you name it, but increasingly companies like an Abercrombie & Fitch, and then also a Lululemon, where you can go online, buy these products in stores and pick them up.
All right, some actionable advice there from Brian Zazi. Saz, thanks so much. Great job on the newsletter this morning, too.
Great help.
All right, let's get to our team coverage here of the biggest market movers following the opening bell on Wall Street. Yahoo Finance's Madison Mills is standing by on the floor for us at the New York Stock Exchange, and Jared Blickery is at the Interactive. Maddie, first over to you here. Just a few first few minutes of trading. What are you hearing from traders down on the floor?
Yeah, so obviously the airline stocks are taking up a little bit of the air in the room this morning with that big Boeing news, down 10% pre-market. But my sources here at the floor are telling me that that is not what is going to define today's trade. One of my sources just pointing to Genesco, GCO, down over 15% pre-market. This is a retailer, going back to some of those retail names that Sazi was just talking about, indicating worse than expected forward guidance. And we're getting some information about some of the other retailers that could be indicating a little bit more of that consumer slowdown this week. Now, why does that matter? Because this could be an indication of the Fed's tightening cycle doing what it was supposed to do. If we continue to get some information from retailers that we're getting, some consumer softening coming in with the inflation picture, that could be an indication that the Fed could be done with their tightening cycle. And what's going to be an indication of how true that is could come at 12:30 today when we get some Fed speak from Raphael Bostic. That could be the thing that defines some of the market moves heading into the latter half of the trade today, particularly when it comes to those Magnificent Seven stocks that are tied to a lot of the ETF movement throughout the day today, you guys.
All right, thanks so much, Maddie. Down there on the floor of the New York Stock Exchange, let's head on over to Jared Blickery. He's got a closer look at the drop that we're seeing in oil this morning. Hey, Jared.
That's right. We're tracking energy. XLE is the worst performing sector of the large caps on the day, down 2%. Worth noting that tech is number one. This brings back the rivalry we had between these two sectors a couple years ago during that nasty bear market. But I want to focus on crude oil. We have CL, that's WTI crude oil, down 4.6%. this is trading at the bottom end of its trading range going back over a year. And here is the spike that we had with the Israeli-Gaza incursion. And then if we take a 3-year look, we can see another spike, which was much greater. This was this was the Russian invasion of Ukraine. So we have yet to see a big geopolitical spike here off of oil. That's something that we're watching because of what's happening in the Red Sea. But in reaction to whatever, I'm not going to impute too much with the kingdom here, their motives, but they have dropped their prices worldwide by up to $2. And this could be either to take market share from U.S. and OPEC, non-OPEC plus producers, or it could just be a reaction to the pricing and the supply and dynamic schemes as they see them. Nevertheless, we are seeing a tight oil market. Saudi Arabia has been running a tight oil market for several years. OPEC Plus is cutting up to 2.2 million barrels per day, and there is some wiggle room within there. So the Saudis and OPEC Plus manipulate oil prices and set oil prices not only through supply and demand by cutting their production, but also by actually setting the prices. And that's what we're seeing in reaction today. Here is our energy heat map, and we can see a lot of red on this board. ExxonMobil down 2.5%, Chevron down 1.4%, Schlumberger down 3%, guys.
All right, Jared, thanks so much. Let's talk more about some of the moves that we're seeing not only here this morning, but also what we've seen since the start of the year, because stocks off to the worst start that we've seen since 2016. We had the S&P 500 down about 1.5% going into today's trading day. Now, despite all of this and some of the worrisome signs out there, RBC capital market strategist Lori Calvasina out with a new note this morning, raising her year-end target for the S&P to 5150. That's up from her initial view of 5,000. Our very own Miles Udland is here to break all of this down. And Miles, you were on with us a couple of times last week just talking about some of the negative sentiment in the market over the last several days, yet Lori saying there's still reason to believe.
I think my favorite part of this call is it's actually a slight downgrade for RBC's view relative to where it was set in November. So when they came out with their 5,000 price target in November, it implied about a 10% increase in the stock market in 2024. Given the gains we've seen, and this was really the theme of all of our conversations last week, Shauna, was given the gains we saw at the end of 2023, how does that shape the 2024 outlook? So now RBC's really looking for 8% gains. So, and it's a tough needle to thread, I think, for a lot of Wall Street strategists. And we've seen this is the fourth strategist who raised their year-end price target in just the last couple of weeks. So I think it's an odd game, right? Trying to figure out where stocks are going to be in a year. And we all know the data that 10% average return, but rarely do you actually see a 10% return for the S&P. So going to be some challenges, I think, for strategists over the coming year. But really looking at a downgrade of the market, though you have an increase in the price target. And it really comes down to how much multiple expansion does RBC and other strategists, how much they think is left in the market. You're still looking at about 22 times forward earnings at the end of next year, which is where we ended 2023. So essentially the market does not want to give companies more credit than they are earning with their earnings, if we can follow that one through.
Yeah, and exactly.
I'm with you.
Well, I mean, that was one of the main points in their executive summary, too, talking about the earnings outlook good enough to justify another year of gains, yet also restrains their enthusiasm on 2024 performance. And they were looking at to some of the other factors that, even when you've got this much optimism, could be perhaps dampeners on that performance.
Yeah, and we're really in the sweet spot for this. Like, are people too excited about the stock market so that I want to be less excited about the stock market? We can go through. They had a bunch of interesting numbers around sentiment, what are forward returns typically when sentiment is this level, so on and so forth. But I think an interesting kind of good but tempered call, if we want to call it that, for this morning.
Cautiously optimistic.
Everyone's
Really
always cautious.
context.
That's the right way to be, right? Let's go through life cautiously optimistic.
Exactly.
We'll be fine.
Thanks so much for joining us here this morning. Yahoo Finance's Miles Udland. Coming up, everyone, we've got more of Yahoo Finance's morning brief, a huge acquisition in the healthcare space, plus some concerning reports about Elon Musk. We'll break down our top trending tickers of the day on the other side of a short break. Welcome back. Let's do a quick check of the markets. We're about 10 minutes into the trading day here, and we're keeping a close eye on a few of the big Dow performers here this morning. Boeing, notably, we were breaking that down for you off of the weekend's events, where it's now leading to the FAA investigating and looking across the 737 MAX 7 and making sure that they're making the necessary updates across the fleet that is in operation by some of the airlines here in the U.S. So focusing in on the Dow here first and foremost, as that's one of the components within the Dow 30. Boeing is. Dow down by about 0.5% right now. S&P 500, you're seeing that lower by about 0.2%. The NASDAQ, higher by about 0.2%. And the NASDAQ composite, that's higher by about 0.6% here this morning. We're also watching shares of Tesla for one of our trending tickers after a report from the Wall Street Journal claimed illegal drug use was the cause of some of Elon Musk's questionable behavior. And executives are concerned about the impact on his companies, including Tesla and SpaceX. What's worth noting here within this is that there were claims that he was using drugs, illegal ones, such as LSD, ecstasy, ketamine, and cocaine, and Musk pushed back on this via a few social media posts saying that not even trace quantities of the alcohol and drugs were found in his systems after multiple years of random drug testing.
Yeah, and I think this is just the latest headache here for Tesla's board, right? Not exactly something that they're unfamiliar with, dealing with some of these side reporting and exactly how it's impacting CEO Elon Musk. But still, the reason why we're bringing this up today is because the pressure that we're seeing in shares, just because of what this means in terms of casting some uncertainty around the stock going forward. We know a lot of the hype and a lot of excitement surrounding Tesla is tied directly to CEO Elon Musk and his vision there for the company. So any sort of scenario where you could potentially down the road not see Musk lead at Tesla, that's obviously would be a massive concern for many of the shareholders out there today. But again, these reports from the Wall Street Journal, just something that adds to some of the risk that is there for shareholders here going forward, and something that could lead to a little bit more caution going forward on the stock.
I mean, even when he was on the Joe Rogan Experience and that podcast, of course, there was a video component to that as well, where we all saw Musk lighting one up with Joe Rogan, and NASA then prompted their own random drug testing for multiple years.
That is true. All right, well, let's get to another trending ticker that we're closely following here, and that is Merck, acquiring cancer drug maker Harpoon Therapeutics in a deal valued at $680 million. Now, the closing of this acquisition is pending approval from Harpoon shareholders. And taking a look at the reaction that we are seeing in shares today, again, this deal would potentially give, or does give, Merck here really an expansion in terms of their pipeline and could potentially solidify the leadership that they have right now in the oncology space. We know that this has been a focal point here for Merck now for quite some time. Their top-selling cancer treatment, we could see some pricing pressure on that drug, Keytruda, towards the end of the decade. So further diversifying their pipeline, their products here of drugs, could be a boost to Merck down the line.
Yeah, absolutely. You mentioned Keytruda. This is the largest product sales driver for the company at the end of the day, and it was already outpacing year-to-date sales comped to the Q3 year end, if you will, at the most recent report. So once we get a little bit more update, plus we're getting more about where they intend to include this within their business. You mentioned the oncology business, but look at this deal. I mean, the move that we've seen in Harpoon afterwards, if we've got to look at those shares, I saw them here pre-market. They were up more than 100%, 109% to be exact here. So $23 a share in cash, and there you're seeing exactly where they're moving right now, 111% higher for Harpoon. They had about a $178 million market cap coming into this. So a nice little boost for them, nice little gain for shareholders at the end of the day. For those who haven't heard of Harpoon, they essentially have this platform that is going to allow Merck to perhaps be able to leverage and bring to light even more of the particular, and it's all about a platform base at this point, but all focusing on the body's immune system to treat patients suffering from cancer and other diseases.
Yeah, so two stocks to keep on your radar, especially Merck, when we talk about what this means for the company going forward. All right, let's also take a look at NVIDIA. It is today's stock to watch. Now, the chip giant is reportedly looking to begin production of a new AI chips for China in the second quarter. This is according to reports from Reuters. Yahoo Finance's Madison Mills standing by with more on that for us. Maddie.
Yeah, so exactly like you said, Shauna, this is our stock to watch today because NVIDIA's market cap stands to have a broader impact on today's trade than some of those other noisy names we've been talking about, like those airlines. Now, why is this stock moving this morning? It's off of that news that NVIDIA is going to be delivering more powerful AI chips, one specific chip in Q2 of 2024 in China. And previously, this had come from NVIDIA. They were working on 2 other chips that would allow them to sell those chips in China in compliance with U.S. regulatory measures. However, this chip is a little bit more exciting to consumers in China, and that's because it's more powerful than those previous 2 chips. We heard from Alibaba, from Huawei previously, that they were not excited about a less good chip from NVIDIA. This chip news today stands to change that. So over the next couple of days, we'll want to see if we're getting any commentary, any reaction from Alibaba, from Huawei on how they feel about this new, more powerful AI chip coming from NVIDIA in Q2 of 2024. In terms of the market action, NVIDIA, the top performer so far today in the Magnificent Seven. Could this be something that traders cling to get a little bit of movement in the Mag 7 after last week's less than good performance on those Apple downgrades? Again, NVIDIA, the best performer so far today in the trade in that Mag 7. Could this name lift up that index as we head into the rest of the day, or could Fed speak that we get later this afternoon throw a little bit of cold water on that market action?
All right, certainly one of the larger questions as we had wrapped up 2023 and now beginning 2024. Is there continued momentum in the Mag 7 trade here? Our own Maddie Mills here, magnificent in her own way. Thanks so much, Maddie. Appreciate it. Well, a strategist at JP Morgan predicts that President Joe Biden could pull out of the presidential election, although the economy and markets are showing signs of not only strengthening, but growth. Could unpredictability during the upcoming presidential election upend that? And how could that impact your portfolio? To help us break this down, we've got Paul Krugman, who is the New York Times columnist and professor. Paul, I know what you're thinking probably. What information does the analyst have more than perhaps the public or even those closest to the president here? But let's kind of game out this hypothetical. What would be the real impact if we did see President Joe Biden pull out from the general election?
Well, I mean, again, what does he know? I mean, if I'm in a pronouncement like that, you should not take me seriously because I have no special information on that. I don't understand why a Wall Street strategist should have any inside take here. And it would cause chaos within the Democratic Party because there is no obvious person to run instead. I mean, and so, and in terms of even if they could unite on somebody, I actually don't think it makes a difference. I don't know much about anything really about the political stuff, but I've been digging a lot into consumer sentiment numbers. And what you see there is Democrats are feeling increasingly good about the economy. They're responding, as you would expect, to a really good year in 2023. Republicans are absolutely, it just doesn't matter. All that matters is there's a Democrat in the White House. So they say the economy is terrible. And that's not going to change. Changing the name at the head of the ticket isn't going to change that. So I don't see any reason to think that this is not going to happen. But it wouldn't really shake up anything in terms of the underlying dynamics of the election.
Paul, give us your sense. You mentioned the fact that there are some perceptions out there, at least among a group of voters, that the economy is still very lousy, despite the recent data that we've gotten showing that it has remained remarkably resilient. As we head into 2024, for investors out there, I guess, how do you see what we're currently seeing in terms of the stability of the economy playing out here going forward, and whether or not you think it's time for the Fed to cut rates?
Oh, it's definitely time for the Fed to cut rates. I like to compare the economic numbers look a lot like they did in late 2019 right now. The unemployment rate is about the same. The underlying inflation is just slightly higher, but very close to the Fed's 2% target now. The Fed's forecast of inflation for the next year is just slightly higher than it was, but the Fed funds rate was 1.75 in late 2019. And it's 5.5 now. It's very hard to justify, given that inflation has collapsed. The war on inflation suddenly is over. We won. And it's very hard to understand why rates should stay where they are now, given that the inflation that was supposed to be the big justification for rate hikes seems to be just gone away. And is there could there be a recession in 2024? Who knows? I mean, there's very little. There's some very, very slight hints of weakness in the data, but economists have a perfect track record on predicting recessions, which is we've never been right. So I don't think that's something we can go on. But the inflation is definitely basically a solved problem.
Yeah, economists have been calling for a recession for the better part of, a year and a half at this point, right, Paul? So at the end of the day.
Decades of experience. The economists have never successfully called a recession. And when there's unanimity that one is coming, it doesn't happen.
What is the largest shift in tone that you're anticipating from the Fed with that regard?
Oh, I think it's a big deal when the Fed basically says we're cutting rates because inflation appears to be largely under control. And they'll probably be much more cautious in the way they say it. But even so, I think it makes a big difference to a lot of people out there. It's one thing to have all of us sitting here with our, with our data and even to have news reports that say that measures of underlying inflation are now close to the Fed's target. It's a very different thing to have the Fed actually acting on that. That's a kind of a validation. We know it's true, but it'll be a very big deal the first time that the Fed says, well, given the progress on inflation, we're cutting rates.
Paul, what would you say is the biggest risk facing the economy in the year ahead, given the fact that, yes, there is a lot of reason to be optimistic, but even just from what you've been saying the last couple of minutes, certainly a lot of uncertainty ahead. So what's the number one thing that you think investors, shareholders need to keep in mind?
Okay, I don't see anything in our own economy that is really pointing to it. There's nothing like the housing bubble in 2007 or the tech bubble in 2020. So there's nothing out there that's obviously set to collapse domestically. Maybe something that we're missing, but it's maybe banks, more bank runs or something like that. Geopolitics. I mean, there are now what's happened so far. The shipping attacks in the Red Sea are by themselves not a huge thing, but it's not good. And look, if China invades Taiwan, then all bets are off, right? So I'd say the main risks are actually geopolitical at this point.
All right, Paul, it's always great to get your insight. Thanks so much for taking the time to join us here this morning. Paul Krugman, New York Times columnist and professor. Thanks so much, Paul.
Thank you.
We'll keep right here on Yahoo Finance. Much more coming up from Yahoo Finance's morning brief. We will bring you the vibe check on Apple. How does the street feel on the back of two key downgrades on the tech giant? We will discuss on the other side. We'll be right back.
Trouble escalates for Apple, with Jefferies saying iPhone sales fell 30% in China during the first week of the year. The tech giant is seeing its worst start to the year since 1982, following 2 downgrades last week. But with Apple's VR headset launching February 2nd, where does Wall Street stand now? We've been combing through some of the Wall Street notes, and I'll take the Vision Pro headset side on the other side of that. But what's Wall Street saying on this right now?
So Wall Street's still relatively bullish. If you take at least a look at the overall numbers, right? They have 33 buy ratings on the stock, 15 holds, 5 sells. Now, I bring this up because when you compare that, yes, it might look good at the surface, though, to what we are seeing from analysts on some of the other tech giants or other leaders of the market back in 2023. When you take a look at some of those other Magnificent 7 stocks, it really pales in comparison. Amazon having 68 buy ratings, Meta 66, Nvidia 59. So Apple, far short of what we're seeing from some of the other largest mega cap tech names out there. But Apple has certainly been in a rough spot over the last several trading days. But really, they have been struggling now for some time. When we talk about the revenue growth, lack thereof, some of the comparison numbers being brought to light here from these strategists over the last week or so, saying that, hey, their valuation, the fact that the stock soared 50% last year, is not supported by some of the slowing growth that we're seeing, which you lift and look under the hood here at Apple. What that means for going forward here, Wall Street currently anticipating revenue growth of just 3.6% in fiscal 2024 and profit growth of just about 7.9%. So we're seeing some of that concern reflected by these downgrades. Barclays was one who came out last week saying that they actually downgraded it to sell. And now we have Jefferies coming out this morning saying that some of their checks point to even further weakness than maybe we initially expected out of China.
Yeah, 7% slippage in the stock price that you've seen since, midpoint of December coming into the start of this year. So that's something worth keeping an eye on. But also perhaps worth keeping both eyes on here, the Vision Pro headset and ultimately that launch here. We've got some of the details that just came out this morning. New era of spatial computing is what they're talking about. And pre-orders actually starting Friday, January 19th here. So it'll be interesting to see what kind of pickup is at pre-order point. But ultimately, it's the price point that they need to come down with, I think. And a lot of analysts, to the extent that they've looked across this headset and to the extent that they've been able to even get their hands on it, they've said not only does it need to get smaller, needs to get slimmer, but the price point needs to come down. We were actually speaking with Wedbush's Dan Ives on this when it was first announced back in summer of last year. And he said that price point has to come down to about $1,500 in the next 2 years, sort of the price point where he ultimately sees this going. But that's the playbook of Cupertino. They've got to make sure that it comes out, has expensive product developers that can increase the use cases around this. And investors are usually skeptical at the onset of some of those price points, but it's when they're able to kind of normalize within the market and bring down the price point for the consumers after you've gotten a lot of the corporate and perhaps B2B purchases that might be made. That's when you bring it down for the individual household level and then make sure it looks like a little bit more like these glasses that I've got instead of me making sure that I mess up my do while I'm putting on that new VR headset.
Yeah, $34.99. That's a heck of a lot of money, right? Yes, this is something to be very excited about, but whether or not there's enough excitement to convince people to spend $34.99, exactly to your point. But I think a lot of people are scratching their heads at this.
We'll list out all of the things I can get for $3,499 for you. We've got a busy week on deck here at the Morning Brief. As you can see behind me today, Yahoo Finance Live is at CES in Las Vegas. Well, it's not behind me, but it's over at the Wi-Fi Interactive. JPM's Healthcare Conference. We're also out there, folks, on Wednesday, and we've got fresh inflation data to bring to you live here. Then, you can't miss Friday, the big kickoff to earnings. We'll hear from the big banks and data. We've got you covered on all of it. Catch us live on Yahoo Finance's Morning Brief.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Kimlani here in San Francisco at the annual JP Morgan Healthcare Conference. And here to kick it off with me is Eli Lilly CEO Dave Ricks to talk about, of course, to start off with, your absolutely runaway year, anticipated this year. Thanks for joining us today. Let's talk about this.
Great to be with you.
Yeah, GLP-1s, absolutely the talk of the town. We're still talking about it at the start of the year after a record year last year with Mounjaro, Zepbound being approved. What can you tell us about how this is all coming together for the company? Because you really shot the firing gun in 2005 with Byetta.
That's right. We've been in this space a long time, as you mentioned. You said GLP-1s, but now we're actually adding other gut hormones, incretins we call them, together. So tirzepatide, which is Mounjaro, and Zepbound is two modes of action, GIP and GLP. And in the pipeline, we have another one coming with 3 modes of action. So you can see we're now learning how to exploit this biology to really affect a whole number of metabolic diseases. So last year was about the launch of Zepbound introduction. That happened in the fall, I think going well so far. Mounjaro had a great year as well in diabetes. Trulicity, our older product, continues to do well. This year, I think, will be about some of the new data releases as we study these drugs, not just to demonstrate they lose weight, which almost everybody loses weight, but what happens to your broader health. We're studying a population with congestive heart failure, a specific subtype called HFpEF, which is a partial ejection fraction. And that's really driven by obesity, so we're really anxious to get those results sometime in the second half. And then also a condition called sleep apnea, which is a common condition that almost 10 million Americans have, that we think we can reduce those signs and symptoms of sleep apnea by losing weight on tirzepatide. So this will be now the next step, to translate those health benefits with great weight loss.
Yeah, absolutely. Certainly something we're all looking at, right, is how much more can you get, what other diseases can get benefited by the work that you've been doing. I also know that you launched Lilly Direct. You're trying to get to the consumers. We saw how much of a run you had on just Mounjaro alone last year. These drugs are in high demand. You're running out at some points in the year. So launching Lilly Direct, getting to the consumer, directly to them with Zepbound first, and then a couple other of your diabetes drugs. What is the goal? Are you trying to cut out the pharmacies and the PBMs here?
We're not trying to cut out anyone. We're happy to work with all those players. What we're trying to do is optimize the patient experience. And we listen carefully to the patients that want to use our drugs or are using our drugs. They're pretty frustrated with the state of U.S. healthcare and how it works for them. So we're trying, with Lilly Direct, trying to do 3 things. One is the direct part, which is get supplies or products from a manufacturer directly. That's an experience we all have in many parts of our life, and some people prefer it. I would say in particular, people with obesity who, when they go out into the world, are often shamed for the way they look. Many people don't consider obesity a health condition. They get blowback at the pharmacy counter, et cetera. So they, in particular, like the discretion of getting that product directly. Secondly, telehealth, which a lot of Americans had experience with in COVID, and some don't like and some do. So here we're serving up a partner in different disease states, actually 3 different partners, who are good at telehealth, and people have a place to land to get that. And why do we do that? Because we've worked with them in various ways to make sure the quality of the programs are very high. And so Lilly can be a trusted source to get that telehealth provided.
Absolutely.
And then, I think the other thing I would say is, in particular with obesity, here again, patients report kind of doctor shopping to find someone who will write them what they know is a solution for their health problem. And so here it's just more convenient. It's not just, though, telehealth. We have a doctor finder tool on our site, so you can put in your zip code and find out who is a certified obesity specialist in your area. And access to healthcare and that knowledge gap with patients and the healthcare system is pretty vast in the U.S., so here's a way to bring that closer together.
Well, it's certainly an interesting play, one we haven't seen before from a legacy pharma player, so we'll have to see what the response is to that and whether or not patients actually see it. You also are having pretty good year. Your stock
up
Last year.
in the last year. Sorry,
It's a new year, so
it's a
everything
new
goes
year.
to zero. We
That
have
is
to do it again.
correct.
Yeah. So, yeah.
It resets,
Yeah.
but you had a good run.
Yeah.
Really reaching record highs. You've been sort of on a slow climb since the pandemic. You're involved with products there, and now with the obesity space, you have a lot more going for you.
Yeah.
What are you looking at next? How do you sort of, give back shareholder value in all of this, and how do you justify all that?
Yeah, well, I think we've, and I'll talk tomorrow at this conference, I think if you're an investor and you're looking at Lilly and you're thinking this is a Zepbound Mounjaro story, I don't think you're reading it right. I think we've been on a, as you mentioned, a long climb, and it's really driven by the productivity of our R&D organization. So I think a bet on Lilly is to bet we can keep inventing new things, not just sell the ones we have invented, which are great as well. Additionally, one of the features of how we've built our R&D engine is one that can innovate inside of a timeline that's shorter than your patent life. And of course, we all know at this conference, you always hear about, okay, who's got a patent cliff coming and what deal do they have to do to make up for that? We want to get out of that business. And the way to do that is to launch products faster than you lose them. That's how we grow. In our industry, everything we launch will go to zero someday, even Mounjaro and Zepbound, right? So we need to create something better, faster than that event. And we've been able to do that. If you look at Trulicity, our GLP-1 once weekly, which launched in 2014, and then in 2022, just 8 years later, inside the patent life, we launched Mounjaro, which is by all means probably a better product for that. And then probably in 2026 or 27, we'll launch retatrutide, just 5 years after that, which is probably going to be a better product than that. So that sort of serial innovation and rapid innovation is something we're very focused on. And then the other part of the story is success across not just weight loss and diabetes, but other areas. You mentioned COVID. We were, I think, the largest seller of COVID antibodies in the US during the crisis. We're proud to do that and save probably 30 or 40,000 lives with those. But in oncology, we're making moves and growing that portfolio of target oncology beyond Verzenio, which is our blockbuster breast cancer drug, really the only CDK4/6 indicated in adjuvant, which can be a curative setting. But we're building a pipeline of, I think, really exciting molecules in oncology, along with Alzheimer's. We do expect approval early this year for donanemab and Alzheimer's, and immunology. Important products like Taltz and Olumiant and Omvoh just launched for Crohn's and colitis.
A really diverse portfolio, and at a time where generally, let's go to the market, a lot of companies are looking at where to make the moves next, especially with all the pressure you're seeing from DC. There's general sort of contraction, I think, a little bit in how people are thinking about where to go, what's beneficial, what you can get into without really getting penalized or getting into trouble. How do you think about that space right now?
You're probably referencing the IRA, but also I think the broader sort of regulatory environment around the world for our industry is tightening. It's true. I think that has two primary effects. One is product life cycles will be shorter. I just commented on our strategy, which is to be faster than the life cycle. So we're moving even faster so that we can launch successive innovation before something like a government negotiation in the US, which is the IRA issue, or shorter patent lives, which are happening. There's a debate in Europe about that, for instance. So that's how we inoculate ourselves against that. The second thing is the world's awash in choice. What used to be branded drugs are now generic and very cheap, and we have to make better and better medicines. That threshold of improvement is going up. I think people expect even more impact from the next medicine. So we have to change how we invest, which is to really demand that when we put our money behind a phase 3 program, and those are $1 billion, $2 billion tickets, that it's going to really change that field of medicine. That's the question we ask ourselves. When we do that, sometimes we're right, sometimes we're wrong. We end up with a good medicine, we want it great. But I think it allows us to compete in a tougher future for biopharma.
And then a final question for you. Going back to the GLP-1 space, lots of interest, lots of competitors coming down the pike. I know you're talking about how you're differentiating by targeting different disease states, as well as getting that timeline faster, like you mentioned. How are you planning to keep the market share, though? Because there are a lot of people interested. There's orals coming. I know you have that, too. So there's so many different options that are going to be coming down the pike.
And that's great for patients. I think that's sort of how the industry works. When there's a big success, everyone will pile in and follow. I think the question, if you look at historic performance, is will we be the leader who gave up the lead, or will we exploit the lead? There will be room for others in various niches and so forth. So, of course, we want the second. And we're doing that, as I talked about, with successive innovation. We've got retatrutide in phase 3, or forglipron, the oral, which is the most advanced oral program out there. We have 6 other clinical stage assets in obesity and the various manifestations. And I think that's where the game will turn next, is who's indicated for what? How can we prove value, not just in weight loss? Yes, we need drugs that provide more weight loss. That's retatrutide's promise. Potentially 25 or even 30% weight loss, which is about what bariatric surgery can do. But also, what have you proven in terms of downstream health consequences? That's where payers around the world are looking for that value. And I expect that envelope of indications to expand. Today, we're pursuing something like a dozen different indications for our portfolio of obesity medications. That will get wider and wider through time. And I think that's exciting, for the health of the world. If you look at adult health, there are so many things tied to excess body weight. And we're just beginning to learn, by the way, all the ways to use these drugs together or in sequence, how to get people on lower doses or even off medication eventually to get those benefits. I think it's going to be an exciting decade ahead for innovation with weight loss.
Absolutely. Well, good thing you got a lead on that. Yep. We'll have to leave it there. Eli Lilly CEO Dave Ricks, thank you so much for joining us.
Great to be with you. Thanks.
Don't go anywhere. Yahoo Finance Live will be right back.
Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We're about 40 minutes into the trading day. Let's take a look at how things are shaping up this morning. Stocks are mixed this morning as the Dow is weighed down by Boeing following that Alaska Airlines incident over the weekend. The S&P 500 and the tech-heavy NASDAQ both moving higher and holding on to gains.
All right, let's take a look at some of those individual names. Crocs, one of the biggest movers on Yahoo Finance today, surging. Look at that, nearly 20% after the company updated its guidance this morning ahead of the 2024 ICR conference. Now, Crocs saying that it expects record full-year revenue in 2023, up almost 11% compared to the prior year. They also are anticipating a strong 2024 thanks to improvement in gross margins.
Must have been those grimace Crocs. And solar company Enphase feeling the love and the light this morning from Wells Fargo. An analyst at the firm upgrading the stock to overweight, from equal weight, saying that they expect a rebound in residential solar as interest rates come down. Wells Fargo saying that Enphase's strong 2023 performance and cash flow allows it to be a defensive play against upcoming headwinds.
All right, and a pair of upgrades pushing Dell shares to the upside here this morning, up just about 3.5%. UBS naming the stock one of its top tech hardware picks for 2024. And JP Morgan upgrading Dell to overweight. That's up from neutral this morning. And again, you're looking at shares rise nearly 4%.
The recent pullback in stocks isn't worrisome for some bond traders. Optimism is fueling interest in treasuries as the Fed looks to cut rates this year. For more on the bond market moves, we're joined by our very own Jared Blickery. Hey, Jared.
Hey, Brad. Investors have not liked bonds until very recently. Over the last few years, we just barely escaped what would have been an historic 3-year downdraft in bonds, and that just doesn't happen. But here we can see the flows of 2023 were dominated by flows into cash. That's money markets, $1.3 trillion. And when it comes to bonds, $276 billion, and U.S. equity, $95 billion. So really, bonds actually took in quite a bit more than stocks last year. And when we think about cash on the sidelines, here's a chart that goes back before the global financial crisis over 15 years. Suffice to say, we are at record highs. So this suggests that there's a lot of money that could come pouring into the market this year. Is it going to be stocks? Is it going to be bonds? Well, or is it just going to be more cash? Hard to say. But let me get to some of the charts around the 10-year. We happen to see the 10-year T-note yield right around 4.01%. 4% is a big psychological number. And let me just show you how important it has been by showing you a chart of what happened over the last year. Last year in stocks, we were having a great year for the mega caps through July, but then as the 10-year T-note yield busted through 4%, made its way all the way up to 5% for the first time in decades, that put a real brake on the equity rally. And then this downdraft of over 1 percentage point, over 100 basis points in a very short period of time, this was a tremendous tailwind, not for just the mega caps, but for all stocks. We saw a huge rush into the laggards into year end. So with the 10-year T-note yield threatening to break above 4%, it just kind of gets into the narrative. What is the Fed going to do? What are the other central banks of the world going to do? And this is the biggest thing driving flows around the world right now. And this is the interest rate structure. This is what global central banks are pricing in for their policy rate. The U.S. federal funds rate sitting above 5%, ECB above 4%, and then the Japan policy rate, that's still stuck in negative territory, negative 0.1%. So we have a Bank of Japan meeting in a couple weeks. Are they going to be raising their rate, or are the Fed and the ECB, are they going to be lowering their rate this year? All those dynamics are going to determine what happens in the global bond market, and it's going to have huge implication for flows. And then here's another interesting fact, just one more thing. Michael Hartnett over at Bank of America is saying the most important thing for the bond market this year, forget about that, it's the Treasury refinancing announcement that we get late in the month, just before month end, and that determines how much the U.S. government is going to sell in bills and bonds. That could be the big swing factor here, guys. So lots happening in the month of January.
A lot happening and a lot for investors to keep track of here over the coming weeks. All right, Jared, great stuff. Thanks. Well, BlackRock and Fidelity, along with others, set to list a spot Bitcoin ETF in the U.S. upon approval, revealing fees in their final S-1 filings. Now, Bitcoin today moving back towards that 45,000 level this morning amid this excitement surrounding a potential approval. Now, here's why all of this matters. A spot ETF is going to be potentially huge here for the industry because it would allow everyday investors to get exposure to Bitcoin opening up the market to millions of potential new investors. Our next guest saying that it is going to be a positive catalyst for the industry, especially for Bitcoin miners. Let's talk a little bit more about that. We want to bring in Jason Les. He's the CEO of Riot Platforms. Jason, it's great to see you. Thanks so much for taking the time.
Thank you for having me.
So, Jason, we brought you on today. Obviously, we've been closely tracking the performance of your stock, up just about 240% in the past year alone. But just last week, we had a guest on, analyst from Bernstein, Gautam Shigani, and he was saying that your company is among his top picks in the crypto space for 2024. So just talk to us just about how big of a catalyst you think a potential approval of a spot ETF is going to be for the industry, along with other catalysts that are on your horizon.
Yeah, we believe the ETF is going to be an incredible tool for unlocking whole new pools of capital flowing into Bitcoin. Historically, a lot of investors who may have had an interest in Bitcoin have been unable to get exposure to the asset. Now with ETFs, a traditionally traded security, those investors can get indirect exposure to Bitcoin and use that as a part of their portfolio management. We believe this is going to bring a huge inflow of new capital into the space that should have a very positive catalyst on the price of Bitcoin, which is a finite asset and becoming more finite every year here, every 4 years here, with the halving coming up in April 2024. And this is I think, a rising tide that will lift all boats in the industry. And Bitcoin miners, well positioned like Riot, are positioned to benefit from this in an outsized way.
What about the other price action here and thinking about the stock? I mean, you're a publicly traded company out there. You have to be thinking about what that sell the news type of event may look like. And, not to kind of put the analyst hat fully on you, but what does that mean for how your role, your team kind of manages itself through an event like this?
So Riot's here because of our long-term vision of Bitcoin. What happens with price volatility in the short term is not as important to us, and we've positioned ourselves to withstand that volatility. We have one of the strongest balance sheets in the strength. We just reported ending the year 2023 with approximately $900 million in net liquidity. We also have one of the lowest cost of production for Bitcoin. Through Q3, we reported a direct cost of about $5,500 per coin. So the price may be volatile in the short term, and we're positioned to weather that storm if so. But this type of event, an ETF approval, the capital coming in, while it may not have an immediate effect, I don't have a crystal ball. I think it's going to have a positive long-term effect on Bitcoin, whether that takes place in the coming months or the coming years. So Bitcoin miners like Riot are positioned to take advantage of that opportunity, and we'll be patient because we're here because of our long-term vision on Bitcoin.
And Jason, you mentioned the, of course, ETF event. What about the halving event that's anticipated in April? What type of impact to the cost on operations are you anticipating?
So the halving event that occurs every 4 years cuts the issuance of new Bitcoin supply in half. This is what makes Bitcoin valuable. There's only 21 million Bitcoin that will ever be mined, ever available in supply. And every 4 years, that new issuance gets cut in half further. That will run through 2140. But by 2032, most all of that will be mined out there. So that is overall positive for large holders of Bitcoin like Riot, because this asset is becoming more and more scarce, and things like the ETF are increasing demand up. I would just touch back on what I said earlier about our balance sheet strength, about our direct cost for Bitcoin. That helps us weather through any volatility that may come around the halving. Historically, we have seen the price of Bitcoin go up in the 12 and 18 months following the halving. Now, that's not to say that history is always going to repeat itself, but with things like an ETF approval and what we're talking about potentially supporting the price around that in that time frame, we think this has the shapings to be another positive, 18, 20 months, 24 months from here. In an immediate term, the halving effectively doubles everyone's cost of production. That's why we focus on having a dynamic power strategy and focus on having low cost of productions to be able to withstand the whatever happens coming through the halving year.
Jason, from an investor perspective, I think a lot of people are sitting there when they take into account that, hey, maybe we could potentially invest in a spot Bitcoin ETF that could be a little bit safer, just given the fact that I think so many investors are a little bit nervous still about the reliability and maybe whether or not it would make sense for them individually to go out and buy Bitcoin. I'm curious from your perspective in the conversations that you're having just about the confidence that you think investors have in Bitcoin right now and what you think that an approval like this potentially for the spot Bitcoin ETF could potentially do to further that narrative and give investors a bit more confidence.
Well, first, I think real world events are continuing to run marketing for Bitcoin. We have seen the value of the dollar continue to go down as money's printed by central banks, particularly here in the United States. We've seen access to transmitting money prohibited all over the globe and even here in North America. So the whole world is doing marketing for Bitcoin. I think that there is a growing interest in Bitcoin knowing the properties that it has. I think investors are starting to see there is value to having a deflationary asset as part of their portfolio. For years, investors have used gold as a inflationary hedge as a part of their portfolio. Fidelity calls Bitcoin exponential gold because, unlike gold, there's only so much Bitcoin that can be mined. Gold can continue to be mined for the foreseeable future here. So we think that, I always encourage people to learn about Bitcoin and learn how it works and learn about actually using the system itself. Short of having that technical expertise and taking that leap, I think the ETF is a tool to give investors a security to access Bitcoin, to get exposure to that as a part of their Bitcoin journey, hopefully eventually owning and using the asset itself directly.
And so to what extent does value for the currency still kind of find itself derived off of utilization versus just being a holding asset type?
I think Bitcoin has a number of value propositions. I think just as a store of value, Bitcoin can fulfill a major need for investors. If Bitcoin reached gold's market cap, Bitcoin would be somewhere around $600,000 a coin. That's how early I think we are in the store value stage. If you want to talk about ability to exchange Bitcoin, Bitcoin is used globally. More and more businesses are accepting Bitcoin, and more individuals are using Bitcoin to transmit value. I think that's a direct result of the growing adoption and appreciation of understanding for Bitcoin. First, you come in for the store of value narrative, and then you need to transmit that to conduct some type of commerce or whatever you want to do with your money. So we are seeing the use of Bitcoin increase. We are seeing transaction fees on Bitcoin higher than they've ever been, and that's a result of more and more people using this network, using this blockchain, using this protocol.
Jason, thanks so much for taking the time here today. Riot Platforms CEO Jason Les, we appreciate it.
Thank you for having me.
Certainly. Well, coming up, what this week's inflation data will signal ahead of the Fed meeting that is set to come. We'll speak with Jeffrey's Thomas Simons on the other side of the short break. Given hawkish notes from the Fed minutes in December and jobs numbers that came out last week, investors appear to be rethinking their bets on interest rate cuts in 2024. Right now, investors are pricing in only 5 or 6 rate cuts instead of the original 6 or 7, and a 75% chance of the first rate cut in March, which analysts fully priced in by the start of this year. And our next guest foresaw a rate cut starting in March, but does he still think so? Let's bring in Thomas Lemons, who is the Jefferies senior U.S. economist, to discuss more. Great to have you here on set with us.
Thank you very much. Appreciate it.
So let's discuss this and where your thinking lies right now as we're just in the second week now, beginning in 2024.
Yeah, it seemed like in the that December period after rates started to fall, everybody had to kind of redo their overall outlook, and then they did, and now it seems like we're talking about that again, right? I've been a little bit more patient, and we'll see if that actually ends up being the correct move here. But I think that just with the sense of kind of continued disinflation, and as inflation continues to go down, how steady nominal rates increases that real rate. This concept that Governor Waller and others at the Fed have talked about recently. That was always kind of my primary motivation for why I thought they were going to be cutting as soon as March, right? Because I do think that in the months ahead we will see some more positive news on inflation. Then it seemed like the economy was picking up a little bit more, and I was starting to kind of feel a little stronger about it. Friday at 8:30, maybe a little weaker about it. By about 9 o'clock on Friday, I think I was back to being more confident about it, right? Because the top line numbers for the employment data that we got on Friday, pretty solid, but most of the details, I think, are telling a story that demand for labor has cooled off quite a lot, and that we're going to see that more on the supply side as we go forward in the next few months.
Thomas, I'm curious to get your perspective on how this compares to when you've done this prior, when you're trying to game out, I shouldn't necessarily say rate cuts, but when you're trying to game out Fed officials and policymakers and what that next move is going to be. How much more difficult? Is it much more difficult this time around, given the fact that the scenario that we are in right now is almost unlike anything we've seen in the past?
Yeah, no, I mean, it's extraordinarily difficult, right? I mean, for better or worse, the majority of my career has been in this sort of 2010s period where Fed rate forecasts weren't all that hard to do, right? Then they got a lot easier to do when the Fed started raising rates because they just told us that they were going to raise rates 75 basis points at a time, right? And now I think you see the difficulty, not only on the private side, but also with the SEP, right? Like, when the Fed puts out their dot plot, you can see in the post-meeting press conference this sort of like pick-apart question process of the inconsistencies of one thing versus another. And you have to deal with that on the private side too, right? So I do think that we are in relatively uncharted territory, just given the impact of communication on financial conditions and the focus on the markets and how that affects the economy. But at the end of the day, I think that it's actually, the playbook has been set from much longer ago, right? Which is this sort of nature of the economy overheats a little bit, Fed raises rates, eventually they leave them high for too long, and then things start to slow down, right? So I don't think maybe March may be a little bit too early to be starting to think about that, but certainly in the second half of the year, I think that that's reasonable.
When do you think we see a stronger turnover in the consumer as well, playing into all of this as the Fed is continuing to kind of balance its own scale of full employment plus where the consumer is lining up?
So again, I had thought that we were going to see that as soon as this holiday season. All this notion of buy now, pay later becoming too much of fuel for consumption, and certainly the other credit card metrics and things starting to worsen.
Which again, a heavy promotional cycle we should add as well.
Yeah.
So not necessarily apples to apples.
That's true. Yeah, no, that's a good point. And I think that the full story fully, needs to be written at some point here on we're just looking at kind of the initial goings, right? But in any case, it seems like it definitely wasn't as worse as it could have been, right? So the rethink that I've been having on this is, we focus a lot on these credit measures and buy now, pay later and things like that. And that affects the sort of bottom 2/3 of the income spectrum quite a bit, right? And I had thought that there was this notion that we had inflation fatigue, that price level problems that were going to cause a slowdown in spending. But it seems like the top end consumer has actually been able to sort of offset a lot of the weakness that we see in the bottom, right? The muddle through story for the economy, I think, is that, right? Which is that you can have this K-shaped recovery where people who do better support more growth and vice versa. It's just a question of where the sort of fulcrum point of that K is, right? I had thought it was relatively high, but it may actually be pretty low.
Do you think the Fed will be able to get inflation under control, avoid any real deterioration in the jobs market, and be able to avoid a recession? Where do you stand on that in terms of your base case?
So I don't think that it's particularly likely that you get all the way down to 2% without getting unemployment up to like at least sort of 4 to 4.5%, right? I mean, that, you know, there's human cost to that with unemployment going up, but that's not any of the sort of disaster, you know, big recession scenarios, hard landing scenarios that we had talked about before. I think that that's reasonable. The problem that I have is that once you do get inflation up to 2 or down to 2% and unemployment kind of hovers between 4.5, the economy still feels very sensitive and very kind of ripe to generate inflation again afterwards, right? Because we are still in a demographic environment that's seeing the prime age workforce continue to dwindle. And that just makes labor more sensitive to supply shocks and demand swings. And you know, the idea being that that would lead to higher wages and then another round of inflation. So that's the Fed's really tricky job is, you know, if they are going to be cutting rates, I don't think that they want to cut rates five or six times like the market has priced in. So long as we do the muddle through, I think maybe 3 might be more appropriate, right? I think that may actually be what's in the SEP. But you know, then we get into a whole other discussion of whether or not 2.5 is really neutral, you know, that sort of thing. So it's another headache for them.
A lot of conversations that we are going to be having on this over the next several months. Thomas Simons, always great to have you. Thanks so much for stopping by in studio here. Jefferies, a senior U.S. economist. Thanks.
Thank you. Appreciate it.
We want to get to some breaking news. Twilio's founder, Jeff Lawson, announcing that he is stepping down as CEO. This is effective immediately. Now the company's president of communications is going to be taking the reins as it struggles with 2 activist investors pushing for significant changes at the company. You're at least looking at the immediate reaction in shares with the stock up just about 7%. Of course, so the question with this change, we have Kozema Shipchandler, who is going to be taking over for Jeff Lawson here, at least in the intermediate. Whether or not that's really going to do enough to satisfy the activists as shareholders and exactly some of the changes, activist investors, and the changes that they have been pushing for now over the last several weeks. And bear it out this morning, writing that, quote, some investors have been pushing for a change given what we had been limited profitability and free cash flow. Those metrics improved significantly over the past year. So again, some reaction that we're seeing in the share price today.
Yeah, over 1.7 trillion interactions a year on behalf of 306,000 customers is what the company reiterated in its statement here, and that coming from now Jeff Lawson, who is going to be departing from the role. But most notably here for Shipchandler, and perhaps what this points out as they're battling some of these activist campaigns as well, coming off of a year where activist campaigns certainly had a lot of weight to throw around, whether that be at Disney, whether that be at some of the other household names. Here for Twilio, I think most notably, it comes back to what type of performance they're expecting from Shipchandler now in this position. Person has spent over 2 decades at GE in driving a high-tech aviation division plus growth in the Middle East region. So perhaps that understanding of some of the business, the operations, the culture, that's going to perhaps come to more to light here, but larger question of where this will satisfy some of those activists out there too. Coming up, everyone, we've got a new report from the Wall Street Journal adding to concerns around Elon Musk. We'll speak with Roth MKM's Craig Irwin on Tesla's biggest risks ahead of its upcoming earnings. That's next.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
It was a roller coaster 2023 for Tesla, from the price cuts to the launch of its much anticipated Cybertruck, but the stock still gained over 100%. A new report from the Wall Street Journal points to concerns for the company. Executives from Tesla and SpaceX claiming uneasiness over Elon Musk's illegal drug use. With the EV giant gearing up to report fourth quarter earnings in the coming weeks, what are the biggest risks for investors? We've got the man, the myth, the legend himself, Craig Irwin, Roth MKM Senior Research Analyst. Great to see you here in person, Craig.
What an intro.
We had to give you the intro.
Yeah,
of course, all the bells and whistles, Craig. Look, at the end of the day, when you think about this most recent overhang, of course, there have been larger questions about Musk's conduct, both inside of and outside of the company. What does this latest kind of drudge of news really put in the throes for Tesla shareholders?
Let's be brutally honest here, right? Drugs are bad, right? Yes. And I'm well known for not being a fanboy, right? I'm not a fan of Elon Musk himself. I'm a huge fan of his success in EVs, right? I think this has been known to people in government for many years. I first had a conversation with someone in a relevant entity about this more than 5 years ago. And I think that there are several other people that could have been highlighted in that article. So it smells like a hit piece, right? Why now is the bigger question. It doesn't make a lot of sense to me, given that Tesla's really executing. They're doing a phenomenal job at SpaceX. And we can talk about real risks that don't have anything to do with Elon's recreational chemistry.
But is there, though, a sort of overhang just in terms of some of that uncertainty, given the fact whether or not investors, shareholders should be looking past these recent headlines, but in terms of what that could then mean for leadership of the company down the line? How do you evaluate that as an analyst?
I think Elon Musk is the key man at Tesla. Mm-hmm. He's the key man at Tesla. You can put him in one of his rockets and send him to Mars. Mm-hmm. He's still the key man at Tesla, right? So he is a colorful, creative character. He is known as being a difficult, charismatic man. I think if he leaves Tesla, we have a big problem, right? He's the one that basically has been the creative drive behind this company. And, I give him full credit for the success of the EV industry today. I think that Musk deserves tremendous credit for the success of the industry. And the industry is inevitable now. And that would not have happened without Musk.
What are your biggest risks? By the way, you won euphemism of the day with recreational chemistry. But at the end of the day here, we got to think about what are the biggest risks to Tesla that you're kind of looking through and trying to evaluate here in 2024?
It's demand, right? Demand and obviously competition, right? So the Lightning most visibly cut its forecast in half. Sell side consensus numbers for about 22% growth. 20% unit growth, right? 20% revenue growth still seems a little aggressive, right? We're going to have continued price cuts. Ever since, even in the first quarter, everybody was saying that the second quarter would be the bottom. Well, no, it wasn't. This last quarter was not the bottom. I don't think that fourth quarter margins are likely to be particularly strong. I think they are quite likely to be weak, even though we did see a 5% beat on units. So we probably see continued margin weakness throughout this year as they put through price cuts. They deal with issues in China. Having BYD larger than them in China is a huge deal. That's their most important, most profitable market. They have fundamental structural challenges that they need to deal with, and it brings us back to, what are the strategic bungles over the last couple of years?
And going off of that, what you just said about BYD and the fact that they did overtake Tesla, what do you think that signals, more broadly speaking, if we take a step back, not just about Tesla, but really about China's involvement and maybe leadership here going forward within the EV space?
Yeah, it's a very important question. They should have launched the mini car. They were supposed to have launched that, or at least made the decision to launch that in 2019, and they punted. Ostensibly because it would have been gross margin dilutive. Well, look at margins now, right? And then, India, they hemmed and hawed, from what I understand, about entering that market. So Times of India has confirmed there's a 500,000 unit facility that's going to get built. Musk has got to start making more noise about that. These are big structural challenges that if he wants to be the player with his 20 million units that he dreams about, I don't endorse that number. But to start getting there, he's going to have to do a lot better job internationally and then as far as diversity of offering.
And so for all of the different kind of hats that Elon Musk wears over this time, you're talking about more kind of considered price cuts potentially, especially within China, to try and retain the consumer mindset in that region, which is shifting more nationalistic, if you will. And then additionally, you got to think about where within the productions that they've brought online, where do they scale that back, as some of the other U.S. automakers have had to do as well with their own operations to try and satisfy some of the more international ambitions that they do have in their EV targets that they've set forth?
So I don't see a lot of scaling back of manufacturing per se. Okay. I think, the idea of maybe Shanghai going to 3 million units, we should consider that on hold. Shanghai will probably look to optimize its utilization at that facility. I think we should really look at, India. I think we should look at Mexico and potentially Canada. And how do they serve how do they serve the North American customer more profitably? Those, I think, are the most important questions.
All right, Craig Irwin, great to have you, especially here in studio with us today, Roth MKM Senior Research Analyst. Thanks, Craig.
Thank you.
All right, well, coming up, lights, camera, action. All the big names from Hollywood showing out for last night's Golden Globes. Was it a big night for streamers? We are going to discuss on the other side. We'll be right back.
Yahoo Finance is here in Sin City, Las Vegas for CES 2024. It is one of the largest tech conferences in the world. I'm Akiko Fujita. I'm here to guide you through some of the biggest tech and new ideas that will help transform your investment portfolio in 2024. Let's take a look inside. The conference officially kicks off on Tuesday, but we're here inside CES Unveiled to give you the inside scoop. Hello, nice to meet you.
Hello, nice to meet you too.
Ready? How's my form? Fourth time, here we go. Here are the three themes defining this year's big tech event. First off, artificial intelligence. All the companies are showing off their latest innovations. We are at the booth for Barracuda. It's a French health tech company that's developed this mirror. It's an interactive mirror that uses artificial intelligence. It listens to your voice and then determines your mood.
How's your day been so far?
My day has not been great, and I haven't gotten a lot of sleep.
We all have our moments of feeling down. It's essential to acknowledge it. Just like a rainy day makes way for sunshine, your mood can improve.
The second theme, auto tech. The world's largest car makers are coming here to unveil everything from autonomous vehicles to flying cars. We've all heard about self-driving cars. This company, Glückskin, is building self-driving strollers. It's rocking the baby. Something every mother can appreciate, every father can appreciate. So you see the light here? The green light here shows that it's on. And if I press it a little, it'll stop to make sure the baby does not run away. And finally, theme number 3, the fun and unique tech you won't see anywhere else. We are in front of the Patch XR booth. You see, this guy is inside virtual reality. The company is a mixed reality software company. It allows users to build all the tools to create music in virtual reality. They partner with musicians. They let you create drum sets. I mean, this guy's got it going. I'm gonna give it a shot. All right, here we go.
All right, here we go. Yeah.
Okay, now we've got multiple layers of beats going. Oh wow, look at this. I feel like I'm sitting in first class. This is just what I need right now. Oh, this is kind of tickling. We're gonna be here all week. Don't miss our interviews with the top tech leaders and demos of the latest gadgets. Oh my God, 13 more minutes. 19 minutes left. He's able to type, right, just by looking. Can we have him spell Yahoo Finance?
Sure.
Yahoo Finance is on the ground for CES 2024. Join us Tuesday through Friday for all your coverage.
It was a big night for Hollywood. On Sunday, the Golden Globes marked the first major awards event of the year in an industry that was hampered by a series of months-long strikes, and also took place at a new home, CBS, taking the reins from NBC. Oppenheimer was the biggest winner with 5 awards, including Best Picture in the drama category and Best Director. Surprisingly, Poor Things won over Barbie for Best Picture for a musical comedy. Barbie did get the event's newest award for cinematic and box office achievement as well, though, so we should note that. I'm just going to bring it back to the Bear, honestly. I think the Bear did extremely well. Jeremy Allen White. You also had Ayo Edebiri. They took home awards as well as the show for Best Comedy Series. So good stuff for the Bear. Of course, if you want to rack up and look up some ticker symbols on the Yahoo Finance platform, look no farther than DIS, Disney.
Yeah, exactly. And I think you're spot on with that. And just the fact that streamers really were one of the big winners in last night. When you talk about the Bear, that's on Hulu, owned by Disney. Then you talk about some of the other success last night with Succession, HBO there with Max. They're winning about 4 awards. Netflix coming away with 3 awards with Beef. So it was a big win for a lot of these streamers. And that was a question going into the night, I think, as well as some of the other big names. And you talk about Oppenheimer, you talk about Barbie. Looking beyond that was how successful some of these streamers were going to be and whether or not they would be able to stack up against it. And I think these awards show that they do.
I mean, are awards shows still doing well, I think, is the larger question.
Well, then we're going to have to wait for the numbers on that one. But yeah,
exactly. We're waiting for the numbers. I mean, at the end of the day, a lot of, whether it be the Golden Globes and the actors, actresses, some of the entertainment community, they've cast a lot of doubt on whether or not they even need to be there in some cases. And that was the case in last night's award show, too. Some of them didn't make the appearance.
Yeah, and we will see what the viewership numbers look like. And it has really been in flux over the last several years. All right, let's take one more look at the markets here before we let you go. Again, the Dow still in negative territory on the back of some of the losses that we're seeing from Boeing. You're looking at the Dow off just about 80 points. S&P and NASDAQ, though, trading to the upside. The NASDAQ up just over 1%. That's all from us today. Rochelle Okufo has you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akutho. Here's a look at what I'm watching this morning. More bad news for Boeing. The jetliner's 737 MAX 9 planes are being grounded until the Federal Aviation Administration deems them safe to fly. We'll speak with a licensed FAA pilot coming up this hour. And stocks saw the worst start to the year since 2016. But with inflation data and bank earnings on tap this week, what can investors expect? Plus, Apple's much anticipated VR headset has a release date. Will this be the turnaround the tech giant needs? We'll discuss that also coming up this hour. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at a mixed picture here at the moment, the Dow currently off about 0.25%. Volatile this morning on that Boeing news. We see currently down about 102 points so far this morning. The S&P 500 in the green, they're up about 0.5%. We're seeing energy the biggest laggard in terms of sectors, but at least still seeing some strong gains this morning. Tech-heavy NASDAQ there in the green, up about 167 points or just over 1%. Big tech on the rise so far this morning. No thanks to Tesla, as we'll get into that a little later. But let's also check in on the Treasury market as well. Well, as we take a quick peek here, we saw that Tesla shares under pressure just there, weighing on the NASDAQ. But as we take a look at how the whole picture starts for the week, looking at the Treasury yields on the 5-year, currently down about 1.4%, the 10-year down about 1.33%, and the longest term 30-year yield also down about 1% on the day so far. Well, we have our eyes on Boeing shares today, selling off as the company's MAX 9 planes are being grounded until the FAA deems them safe to fly. Now, this is following an incident on Friday where a side panel was blown out mid-air on an Alaskan Airlines flight from Portland to Oregon to Ontario, California. A small section of the plane's fuselage blew out at 16,000 feet. There were no deaths, and the flight was able to return safely to Portland. The National Transportation Safety Board has since found the panel in the backyard of an Oregon teacher's home. Now, this incident comes just a week after the aerospace giant warned its customers about potential loose bolts in some of its 737 MAX jets. So how are pilots feeling about these aircraft? We have Anthony Roman. He is the founder and CEO of AC Roman and Associates, as well as an FAA licensed commercial pilot. Thank you for joining us this morning. So, for people who are still getting up to speed on this story here, talk about the use of this particular door and how planes tend to use it versus a typical emergency door, how this space is used.
Well, the space is used as an emergency door, given the type of configuration of the seats in the airplane that actually is requested by the airline during the order process. If that does not provide a second emergency door exit, then a door plug is used, very similar to a door, but there's no access to that door from the inside of the aircraft. Quite frankly, the question remains, was that door design flawed, or was it a mechanic who incorrectly closed the door prior to flying?
And thankfully, this happened at 16,000 feet. I mean, it's obviously still very terrifying, but versus being at cruising altitude, for people who would be on the plane in that sort of environment, what would that actually feel like? What would be happening inside the plane?
It's a terrifying experience, frankly. And they are quite fortunate, yes, that it happened at a lower altitude where the air is a bit heavier and thicker. And so the decompression would not have been as terribly violent as it would have been at 32,000 feet, yet extremely dangerous. When that heavy door is ejected from the fuselage, they are quite fortunate, one, that it did not hit the empennage of the aircraft, the small wing and tail in the rear. The airplane would likely have lost control and everyone would have been lost. If you're in that aircraft, when that explosive decompression occurs, frankly, it is an explosive sound that must have terrified the passengers. They must have felt that this was the end. And simply the air rushes out at hurricane force from the cabin, and anything that was not secured, any objects soft and hard, would fly out of that hole where the door was ejected, and that in itself could cause severe injury or death if a passenger is hit with a hard object flying out. Terrible experience.
So, Anthony, when we think of where we go from here, obviously a horrible experience for those on the flights, but what about the wake-up calls in terms of the training that's needed and the investigations needed to really secure these planes?
Well, I think that the flight crew performed superbly, frankly. They were disciplined. The flight attendants, whose primary responsibility is certainly not serving food or helping you find your seat. It certainly is safety, safety first, and coordinating the emergency procedures when an incident like this happens. In this case, the recordings reflect that the flight attendants performed superbly and probably saved many passengers. The flight crew performed as expected, professionally, communicating with air traffic control and descending at a proper descent rate and landing the plane successfully. Missing a door can cause some control difficulties, flutter on the empennage, which creates shaking of the controls in the cockpit and other difficult maneuvering type of problems. So the flight crew, superb.
And you certainly have to have nerves of steel in that sort of environment where you know, everything is happening and it's so loud. And as you mentioned, almost an explosive sort of environment when something like that happens. So I do want to ask you then about some of the warning signals, because we're seeing reports that there were some concerns about depressurization issues with this aircraft. How difficult is it for staff to really voice their concerns and have them addressed properly?
Well, it's procedural. And believe me, the flight crew, when they see pressurization problems in that type of aircraft or any type of aircraft, the first thing they are going to do is run their checklist. And then if that doesn't resolve the problem, notify the mechanics and have it inspected prior to flight. What surprises me here is that this incident occurred several times, including depressurization problems just the day prior to the accident. And I'm surprised that Alaska Airlines did not ground their MAX 9 fleet and conduct a thorough inspection of all of the aircraft to see it could be replicated. What they did do, I think, was very limited in nature. They prohibited Alaska Airlines MAX 9s from overwater flight. A good judgment, but I don't think that it was sufficient given what happened on this plane several times.
So what do you think needs to be communicated from here on out? Obviously, a lot of people, you still want to fly, they want to feel safe, perhaps feeling a little bit unnerved about what they're seeing in the news. What should people remember as they're seeing these stories flying by?
Well, the FAA has grounded all MAX 9s. The NTSB is currently performing investigations, both forensic and physical inspections of the aircraft, all of the systems, including the flight data recorder, which records all of the control actions that both pilots conducted following the incident and prior to the incident. Regrettably, the voice data recorder was overwritten, and so all communications between the pilots has been lost. Fortunately, it's procedure for air traffic control to preserve the recordings of the communication with the pilots prior to, during, and after the emergency. So at least the NTSB and FAA has access to that.
We appreciate you taking the time to join us. A very important story here. We know a lot of people watching. Anthony Roman, founder and CEO of AC Roman & Associates and an FAA licensed commercial pilot. Thank you for joining us this morning.
My pleasure.
Well, the stock market had a rocky start to 2024, snapping a 9-week winning streak as the Dow and the S&P 500 logged their worst start since 2016. Our very own Jared Blicker was tracking those moves. So, Jared, how bad was it?
Rochelle, let's just back up a second because you said something really important. We are coming off a 9-week winning streak that just snapped last week. So it's normal to expect some consolidation here after a blistering rally. And we're seeing the S&P 500 up today. But more importantly, Rochelle, to answer your question, the year to date so far is negative. This is the first 5 days of January, the first 5 trading days. And you can see the S&P 500 is down 1%. This is important because January is a bellwether month. And what happens in January can actually predict with pretty good accuracy what happens the rest of the year. So let me just show you how this breaks down. And all of this comes via Stock Trader's Almanac. These are seasonality studies done by Jeff Hirsch and his late father Yale Hirsch going all the way back to the 1970s. And it was in the early 1970s that the Santa Claus rally was first discovered. It is a 7-day period, the 5 days, the last 5 trading days from the year, plus the first 2 trading days of the year that equal the Santa Claus rally. That's one of these 3 January indicators. Secondly, I was just talking about the first 5 days. This is January 2nd to January 8th this year, so ending today. Finally, we have the January barometer, and that's simply the trading returns for the entire month of January. If all 3 of these are negative, it actually predicts with 80% certainty that the year will end in the red. So that's something we want to pay attention to. Now, if it comes in mixed, and there's a lot of ways you can slice and dice this, we can actually make some other predictions about that, but I will be bringing these on a day-to-day basis. Suffice to say, we are in the red for the year, and that portends potentially red for the rest of the year. I just want to show what has happened in the sector action because that's also very telling this year. Utilities is in the leader. That's up 1.8%. That is defensive. Healthcare, number 2, that is defensive. Financials, not defensive. That's actually good to see. It's more value and cyclical, but staples also in the green. So bottom line, we're already starting out the year very defensively, which is a market reversal from last year.
Indeed, quite the turnaround. Appreciate you breaking all of that down for us, our very own Jared Blickering. Well, could volatility be creeping back into the market? The volatility index was at its lowest level since the pandemic to end 2023, but a week into the new year and the VIX is up nearly 5%. So how worried should investors be, and can we expect more volatility from here? Let's bring in Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thank you for joining us this morning. So as we're looking at this volatility to start the year, what are you making of it, seeing especially how strong some of these defensive sectors are to kick off the year?
I think there's a lot of fear out there. And when you look at what's going on, the market is trying to process several different things. First of all, there's growth. Are we going to have a recession? It doesn't look like it. You look at the jobs reports, they're coming in strong. We don't have recessions when people are working. Second of all is interest rates, but that depends on inflation. Is inflation going down to 2%? It doesn't look like it. So there was an expectation at the end of last year that the Fed was going to cut rates maybe 6, maybe 7 times. And the Fed said 3. And as we get the data, people are saying, well, maybe we're not going to get those cuts. And maybe we should be cautious and pull back. And I think that's exactly what we're seeing.
And so, Brad, how do some of these mismatches factor into this? You have the Fed, trying to essentially hedge their bets, but still saying, look, we're not ready to cut rates just yet. Markets charged ahead. Now we're seeing some of that more sobering effect. You have consumers not feeling good about spending, still spending rather robustly, although starting to pull back slightly. If you're an investor, how do you view these mismatches and where are the opportunities to be had?
Well, I think that first of all, what we're looking at is something we've seen several times during this cycle. We have seen the market say, oh, the Fed is really going to cut rates, and the Fed says, no, we won't. And the market talks itself into believing it, and then the Fed says no, and the market sells off. And we've seen that over and over again, and that's kind of what we're seeing right now. The market talked itself at the end of last year into saying we're going to get rate cuts. The Fed has said, probably not. And that's the reaction we're seeing. But at the same time, the opportunity here is simply we've seen interest rates move up and down. So there's opportunities in fixed income. You can get paid for that. There's opportunities when the market sells off. You can buy into fixed income with the expectation that indeed rates will go down again. So there's a lot of opportunities in fixed income. In terms of the market, I think we're seeing people betting on a defensive position. I think that's where you want to be. Both utilities and consumer staples are good places to be to hedge a slowing but growing economy.
And Brad, interestingly, you note it's not when the Fed cuts that's the right question, but why the Fed cuts. Dig a little deeper into that for us.
Well, the thing is, and this goes back to your last question, which is simply, why does the market expect the Fed to cut rates? Well, the market expects rates to go back to where they were. But why would they? Because rates have never been in that range except when the Fed has decided to stimulate. And when we look at the situation right now, the Fed has two mandates: inflation and employment. Employment is fine, so they can focus on inflation. Inflation is still too high. They're not going to cut until we get back to 2%. Why would they cut? They have no reason to right now. In fact, they have reason to keep it higher for longer. And that's where we are.
So then, Brad, keeping in mind that we're, going to be kicking off earnings season as well, then how much of that do you think we're going to see showing up in some of these earnings calls?
I think the interesting thing is we've seen earnings consistently beat expectations. There's a lot of talk out there in the analyst community. We're going to have a recession. We're not going to have a recession. But at the same time, we have companies coming out there very deliberately and very reasonably saying, hey, there's a lot of things that could go wrong. So they can successfully lowball the earnings expectations. So I think what we're going to see is we've seen the expectations coming down, but they're still reasonably healthy. And I think we're going to see earnings continue to beat those expectations. And that's where I think the upside is, really. Not so much in valuations, but in real earnings growth. And I think that's exactly what we're going to see.
So then, Brad, as we take a broader look then at the volatility, what sort of swings are we expecting here? Are we expecting sort of narrow volatility throughout the year until we get a definitive decision from the Fed? Or could we really see some real changes, given that it was the Mag 7 that really got us to this point in the first place?
And that, of course, is the billion-dollar question. I think when we're watching this, what we need to take a look at is valuations, because as we see interest rates fluctuate, the valuations can bounce around, but probably there's a floor at about 10% below where we are right now. I'm not saying we're going to get there, but we have support there. So that's probably the lower limit if we do get more downside. And that's going to be largely upset over time, I think, by earnings growth this year. So I think we're going to see short-term volatility, but limited volatility, and then renewed growth probably towards the second half of the year.
Well, at least for now, a bit of a bumpy ride so far for this first half. Appreciate you joining us this morning. Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thank you so much. All right, well, Bitcoin bulls are on tenterhooks as the SEC is expected to decide on a spot Bitcoin ETF this week. We dive into this with an analyst on the other side of this break. It's a big week for Bitcoin bulls. Any day now, the Securities and Exchange Commission will decide on whether 14 different money managers are allowed to launch their own spot Bitcoin exchanges traded funds in the US. Now, Bitcoin managed to close out 2023 with an impressive 156% gain, as optimism for a spot Bitcoin ETF fueled the cryptocurrency higher. Our next guest believes the imminent approval could be a large catalyst for Bitcoin's price in 2024 and many more years to come. He joins us now, Sam Callahan, lead analyst at Swan Bitcoin. Thank you for joining us this morning. An exciting week on deck here. So talk about why you're so optimistic about where Bitcoin's price will go from here, given that other spot Bitcoin ETF approvals in other countries haven't seen as much of a surge.
Yeah, thanks for having me. I really appreciate it. So it's certainly an exciting time in Bitcoin. And the reason why the industry is so excited about a spot Bitcoin ETF is it'll give access to millions of investors who currently find it a little bit harder to get exposure to Bitcoin. It'll now be as easy as any other stock or bond to purchase Bitcoin in a traditional brokerage account. But specifically, who this helps the most is large institutions that manage trillions of dollars of wealth. Think financial advisors, broker-dealers, endowments, pension funds. Right now, it's not that they don't want to get exposure to Bitcoin. They can't because of regulatory requirements that restrict them from buying spot Bitcoin. But a Bitcoin ETF changes that because it's just a security like any other stock or bond. So it fits into their existing regulatory frameworks. And so now what we could potentially see is these large institutions investing tens of billions of dollars into these spot Bitcoin ETFs, which will drive demand for the underlying Bitcoin. When you couple that with Bitcoin supply, which is fixed at 21 million, it's not really difficult to see why the industry is excited about the potential moving forward.
Because some people are wondering, obviously, we didn't see spot Bitcoin ETF. We didn't see the price sort of skyrocket in other countries that have adopted it. But as you look at some of the names that have amended their S1 forms in the run up to this, obviously BlackRock, ARK Invest 21 shares, VanEck, Wisdom Tree, Invesco, Fidelity, among some. What does that tell us then about sort of these last minute changes? What does that tell us about the preparedness here for some of these big investment banks?
Well, these are large players. These are the largest financial asset managers in the world. BlackRock, Fidelity, they're just crossing their I's and crossing their T's and dotting their I's, getting everything in order with the SEC to make sure that everything's in order for them to launch these spot Bitcoin ETFs. And I think when you compare other ETFs around the world, like at the Toronto Stock Exchange, that was kind of launched at the top of the bull market, and then they saw a decline in the price. So just in terms of the cycle, when these are launching today, we're coming out of the bear market. We have a lot of momentum coming out of 2023. We have more regulatory clarity in terms of the broader crypto markets. And it's really a constructive time for Bitcoin when you look at other developments, such as the FASB accounting rule changes that are going to allow corporations to more easily buy Bitcoin on their as a treasury reserve asset. When you look at the broader macro picture of the Fed expected to cut rates, you can see why there's going to be a lot of demand for Bitcoin. And just the education levels compared to 2021 and 2023 today, it's very different. These institutions now better understand this new technology, and they understand the value proposition of Bitcoin. And so that's why I think you're going to see a lot more inflows than maybe what we saw in these older ETFs that launched abroad.
And we definitely see, obviously, more expertise coming to the table from institutional investors. Is that the same though for your regular retail investor here? What should they be aware of as they're sort of perhaps getting caught up in the hype, wondering if this is going to be the big catalyst of where Bitcoin is going to go from here?
Well, I think what retail investors need to understand is that, Bitcoin might be volatile, but it is the best performing asset 7 of the last 10 years and 10 of the last 13 years. And so it's very important to view Bitcoin as a long-term savings and as a way to protect their wealth from debasement, as well as to hedge their portfolio, because Bitcoin moves in a way that's uncorrelated to other stocks and bonds. So a lot of these institutional investors are now, you're hearing recommendations of a 1% allocation, a 2% allocation, or a 5% allocation into Bitcoin as a way to diversify risk of a portfolio and improve the performance of an overall portfolio. And so I think it's important for investors to not just buy Bitcoin, but to learn about what they're buying. And what they're buying is a scarce digital store of value that allows themselves to protect their wealth over long periods of time, as well as provide uncorrelated returns that help reduce the risk of an overall portfolio.
So as we're looking at Bitcoin currently sitting at above 45,000 here, what does that road for Bitcoin look like for the rest of the year? How high do you expect it to go between what we're seeing with spot Bitcoin ETF potential approvals, as well as the Bitcoin halving that's supposed to be taking place in April?
Yeah, there's a lot of potential catalysts for Bitcoin's price. And what you mentioned basically is on the demand side, we have new on-ramps like the spot Bitcoin ETF. Like I mentioned, that's going to make it more accessible than ever before for retail investors as well as institutions to buy Bitcoin. And at the same time, you have on the supply side, the halving event. And that's where every 4 years, the amount of Bitcoin that gets issued gets cut in half. So it basically makes the available Bitcoin more scarce. And so you have two dynamics, increased demand, and it's getting scarce at the same time. And that is really constructive for the price moving forward. And if you look at past cycles where there's been a halving, Bitcoin's price tends to run after these halving events. And when you couple that with some of these more constructive demand factors, you can see why people are really constructive about the price moving forward. And there's been a lot of, I try to stay away from like specific price predictions. But if you look at the historical performance of Bitcoin, the years after these halving events, and you combine that with the increased institutional adoption, and Bitcoin could reach new heights into the 6-digit figures in 2024 and beyond.
And Sam, I have to ask you, because obviously when it comes to stock markets overall, people think of the Oracle of Omaha, you think of Warren Buffett. Who would be that for Bitcoin? I'm watching some of the moves by Michael Saylor of MicroStrategy here, selling some stock here, buying a lot of Bitcoin here. What is the move here for some of these big name investors and how they're approaching this?
Well, I do have to applaud Michael Saylor. I think what he's doing is brilliant in terms of he's looking at his equity. He's saying it's overvalued, so he's issuing more and then turning around and buying a scarce digital store of value with it and put it as a treasury reserve asset. And I think it's a brilliant strategy. And I think what these large high net worth individuals or institutions have to consider is what I mentioned before, is that a little bit of Bitcoin goes a long way in terms of improving the performance of your overall portfolio. And you have to consider how to hedge against certain risks, like counterparty risk. When you look at the bank failures that happened in the spring, you might want to own a little bit of your wealth in something that you own yourself, that you can actually take ownership with. You don't have to hold it with any kind of trusted third party. That also protects yourself in a more structurally high inflationary environment. In an inflationary environment, you want to own hard, scarce assets. And so that's why you're seeing financial advisors and other institutions, institutional investors like pension funds start to allocate towards alternative assets that are hard and scarce to protect their wealth against inflation. And so if we are entering this period of structurally higher inflation, it's hard, scarce assets that you want to own. And there's nothing more scarce than Bitcoin. And so I think a small amount goes a long way, and you want to own hard, scarce assets in an inflationary environment. And that's why Bitcoin is really attractive to all investors.
We'll certainly be tracking its performance. Excited to see where it goes from here. Sam Callahan, Swan Bitcoin lead analyst. Thank you for your time this morning.
Thank you.
Well, Apple's Vision Pro augmented reality headset will be available in the US starting February 2nd for more than triple the price of Meta's most expensive headset. Now, will this device give the tech giant the comeback it needs? To break this down for us, Yahoo Finance reporter Dan Howley is here. Dan, I know we've been waiting for this one, so what are your thoughts here?
Yeah, Rochelle, this is a big announcement coming on Groundhog Day. I just think that's a funny time for it to launch. It'll be $34.99 when it hits the market February 2nd. Pre-orders start January 19th at 8 a.m. Eastern. That's 5 a.m. Pacific time for people who have $3,400 or $3,500 to go out and spend right away. Just a few other kind of points to mention. The base storage for this is going to be 256 gigabytes. So you'll have enough on there for photos, things along those lines. There's going to be a pair of readers in there, so like reader lenses. They're going to be $99 extra if you need those. And then if you need prescription optics, those are coming from Zeiss. and they're going to be $149. So that's an addition to the $3,500 that you would spend on the headset itself. You would get these prescription lenses. You would go into an Apple store. They would kind of have you set up. Yeah, I had previously tried these back in June at the WWDC event. You use the kind of FaceTime camera on your iPhone to look at your eyes, take measurements of your face, and that's kind of how you figure out the kind of light block that you're going to need that goes around your eyes and ensures that you're basically sealed off from the rest of the world. So there's a lot that goes into this. It's not just walking in and picking up an iPhone, or even trying out a pair of AirPods to see if you like them in store or not. Something you can do, by the way. This is going to be a very delicate kind of setup process for Apple. The fact that they're offering the online and in store at the same time is really interesting. But for Apple overall, this is their first major product category that they're getting into since the Apple Watch. So this is a long time coming. It's still an unproven market. The smartphone market globally sells billions of devices a year. The headset market sells millions. So a huge difference in the amount of demand. We have to see if Apple then can ramp those numbers up. But $3,500, it's a lot to ask.
Indeed, but chatting with some of the Yahoo Finance crew here, we're seeing at least they're thinking of those of us who have eye issues, who need to wear glasses or contact lenses. But that price tag, yeah, that's hefty. But I mean, it looks cool. The cool factor is tough, especially if you want to be an early adopter. Appreciate you always giving us the latest. Yahoo Finance reporter Dan Howley, thanks so much. Well, will gamers soon be clamoring to Netflix? I talked to an analyst about the streaming giant's big bet on gaming next. It's game on for Netflix. The streaming platform's executives reportedly in talks to possibly introduce ads and microtransactions in its games. That's according to the Wall Street Journal. Our next guest, though, says although this is a good way for the streaming giant to diversify its revenue stream, there's still a long way to go from making profit. Brian Mulberry, Zacks Investment Management Client Portfolio Manager, is here to break it down for us. Good to have you on the show here. So for a lot of us who have Netflix, gaming isn't even something that we've even thought was part of our subscription, as I today was finding out that it is. What does this move mean for Netflix and really the sort of viewership they could be bringing here?
Well, you certainly see the size of the gaming market growing exponentially. Currently, it's around $200 billion expected to triple in the next 10 years. So you're looking at 10% annualized growth just in the gaming market itself. And when you consider the content creation that Netflix has invested in, it makes sense to try and translate some of that CGI and perhaps AI fueled content into gaming. It's a huge market, especially overseas, with Asia being the biggest market available. And so it makes sense that they would want to try and play in that pool, if you will, and capture some of that revenue that might be available. So they're already doing some of the work behind the scenes in terms of content creation. Now it just simply seems a question of how well they can compete in a very highly competitive marketplace when it comes to a lot of the games that are already available out there. They've got great growth in terms of adoption and new users on Netflix. Can they transition them to a gaming model? That's where we have to wait and see what actually happens.
And it's interesting because even when you look at some of the names of the games on here, some of them well-known franchises. You have Grand Theft Auto, but some of them actually build on existing Netflix shows like Money Heist. So it's really tapping into sort of two different audiences here. But how much of a competitive edge, especially when it comes to gaming, can Netflix have for now, and where will it go from here?
Well, obviously, they're trying to do the best to capitalize on properties that they already have. The problem is that you already have some very well-established games out there like Fortnite and Minecraft that are in the same storyline type of category. Now, I appreciate that they're co-branding some of the content, like I said, that they're currently streaming from a video perspective, trying to get into that gaming segment. But again, it's just the adoption rate that we're worried about, if you will, in terms of being able to monetize the actual product. Now, once they do, we certainly see a clear path forward where you're able to capture more money over time in the gaming segment rather than just buying a particular show or a particular movie and you only get that one-time revenue, if you will. Gaming provides an ongoing stream of revenue for in-app purchases and all of the things that you can do along those lines in terms of growing the business and growing the revenue. So we certainly understand the model, and they're certainly very serious about it. They've made big investments, including partnerships with all of the mobile producers out there. So AT&T, Verizon, T-Mobile, they're signing agreements with them in addition to Dish Network and Comcast, because we all see that mobile accounts for roughly half of the gaming revenue right now. It's around 46%. And so they're making the right investments in the right places to try and capture it. Again, it's just all comes down to that adoption rate and the migration of viewers into gamers. It's less likely to be happening here domestically just because of the pure brand power that you have of existing games. Again, Minecraft, Fortnite, Madden, all of those types of properties that are already so very popular here. But they also have done very good, Netflix in particular, at growing foreign language content abroad. And we would expect them to try and capitalize on that in this new investment in gaming as well.
And so as we look at some of the shifting dynamics here in terms of how Netflix is investing versus it used to be sort of big names, all about the content, just growing the subscribers. But when it comes to shows, we're seeing reports here, Netflix cutting over 100 shows in really a major programming shift. How big of a part do you think gaming and things like live sports is going to play in Netflix's future growth? And as you mentioned, growing the international market as well.
Well, like I said, you're looking at 10% annualized growth in the gaming market itself. It grows to, an entire market of around 600 billion globally by 2032. If they just capture 5% of that as a share, that's an extra 30 billion in revenue to a company that currently generates around 35 to 40 billion on an annualized basis, looking at where they're at right now. So again, we understand why they are wanting to play in this particular market. We also understand, again, there's synergies here with what they're investing in for streaming content. They can easily repurpose into the gaming network. And this becomes, a $1 invested going two different ways to make money on the back end. And so we see this, the pressure, if you will, on the higher cost of creating content now. And they're also obviously looking to make better use of those dollars that are invested. The knock on the balance sheet when it comes to Netflix is that they do have quite a bit of long-term debt that's out there, and they need to continue to service that by diversifying revenue streams. So that seems like this is really where that bet is headed towards in terms of offsetting those long-term costs by generating more revenue from the same dollar spent.
So Brian, what do you see as the biggest risks of expanding into gaming with this new ad tier here?
The biggest thing is that it's a highly competitive marketplace. And if I can have more fun with less interruption on a different platform, then that's where users will tend to go. So the question is, what does the interruption look like? Is it something that turns users off or away from that particular platform in the games that they like to play? you're only looking for entertainment value when it comes to gaming as it is. And so if it becomes more of a distraction or a disruption in the experience I'm trying to enjoy, then obviously the adoption rate will reflect that. So that's really kind of, we understand the monetization part of it, but it also has to be an enjoyable, fun platform. That's what gaming is all about, and that's what users are looking for.
So then, as you're looking at this from an investment perspective, then, is Netflix, does it have a lot more upside here versus, say, some of these others that are pure play in gaming?
I think that there is more upside here. Again, they're already spending money on content creation, and we think that they have been successful, again, offshore, if you will, not here domestically in the US, but in international markets, they've done really quite well at organic content creation. And there's a bigger growth model for offshore markets in gaming anyway. Again, Asia is going to account for roughly half of that market alone. And if they can transition those viewers of those shows into a gaming platform that models that, then there actually should be quite a successful model going forward. For investors, they're going to have to look beyond just what happens in the US markets and US gaming to really gauge how successful and how profitable this is going to be long term for Netflix.
I'll definitely check it out. I'll start playing around with it. I mean, it's already included in the subscription. So I was like, let me at least play around and see. You never know. Obviously, I have nieces and nephews always looking for games. I was like, Netflix is right there. Appreciate you joining us, Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Thank you so much.
Thank you.
Well, of course, the Golden Globes took place last night with Oppenheimer raking in 5 major wins, including Best Picture, Drama, and Best Director. But it's not all glitz and glam in Hollywood. Movies are still rebounding from the writers and SAG-AFTRA strikes that took place at the end of last year, and struggling box office levels that haven't rebounded to pre-pandemic levels. Let's bring in Gitesh Pandya, Box Office Guru founder and editor, to discuss more. Thank you for joining me this morning. So first, I want to talk about the Golden Globes. This was meant to be this sort of revamped comeback here with, with CVS, this for-profit model. But when you look at what's trending this morning when it comes to the Golden Globes, what do you think are the biggest takeaways here?
Well, look, overall, it was not that great of a show. First of all, the host, Joe Coy, who is someone I like. If you've seen his stand-up comedy over the last 10 years, he's a really funny comedian. Not the right guy for the job, didn't do well there. And I don't see him getting invited back to host anymore. But overall, Oppenheimer, as you mentioned, was the big winner of the night. Best Picture Drama and also Best Director. Those are the two of the biggest awards of the night. It is the front runner now for the Oscars, which will happen in March. Some other winners there too. Robert Downey Jr., he won for Oppenheimer as well, Cillian Murphy. So that definitely dominated the night. And you had some smaller wins too for some smaller films. Some were surprises. So a little bit of a mixture of the big budget and the small budget. But one thing to remember is that the Golden Globes voters and the Oscar voters are two completely separate groups of human beings. So it doesn't necessarily tell us what's going to happen at the Oscars, but it does tell us where the trend lines are and where the momentum is as those nominations for the Academy Awards come out in just a couple of weeks.
Indeed. And when you think of what you saw on social media's reaction to it, and even as you look at viewership numbers for the Golden Globes, does it still seem like a good investment, given that there's just so much competition for viewers' eyes at the moment, and sitting down for multiple hours to watch an award show just doesn't seem to be doing it for people?
Well, I think in the last 10 years, we've had an oversaturation of award shows, but the Golden Globes really are arguably the second biggest show in the movie business and the TV business. Obviously, the Oscars, the Emmys, those are the must-see events. But the Golden Globes have done a good job over the many decades of bringing all those stars together. And you saw last night, the biggest stars in Hollywood were all together. Harrison Ford, Meryl Streep, DiCaprio, Timothée Chalamet, Margot Robbie, you name it. They were all under the same roof. And after the strikes took away a lot of these big stars for many months, they were happy to be there. We were happy to watch them. And I think that they'll take a lot of notes to try to make it better next year between the hosts and also the nominees and the format of the show. Remember, it did change from NBC for decades over to CBS. So you have a whole new team putting the broadcast together, a lot of snafus, but I think they have room to make it better next year. And it is the first big one of the calendar year. So that makes it exciting for not just the audiences, but also for the industry and for advertisers.
And as we look at the industry, obviously last year was all about Barbenheimer. Do we expect that same, can we repeat that same sort of magic this year? And what does that mean for what we're seeing in the space for M&A as well, as we're really trying to get more value, especially for investors, out of some of these movie franchises and stocks as investments?
Right. Well, the studios have been relying on franchises every year, sequels. Barbie was not a sequel, but it was a brand. Super Mario Brothers, another brand, not a sequel. They really drove the box office last year. Barbie was the #1 movie of the year, $1.44 billion around the world. 1 year ago now, nobody could have predicted it would make that kind of money. So there's always surprises at the box office. Right now, the calendar looks a little bit light because of the strikes. A lot of projects have been delayed, and so this calendar year looks a little bit weak. However, just the nature of the business, new movies will be added later, and there are surprises also around the corner every year. So we cannot truly predict what the year-to-date box office will be come December because of all those surprises and so on. However, the studios are looking to go through a year of changes. This is a world where all these studios may not be able to survive in the long term because of all the changes that are going on, not just on the studio side, but also with the audiences. Audience and consumer behavior has changed a lot. There's social media, there's TikTok, there's Instagram. People are spending trillions of minutes on these free platforms, and that's trillions of minutes they're not spending watching movies and TV shows. So that really begs the question, will we see some M&A activity this year? And I think that we will. I think that between streaming and television and film, a lot of them cannot survive the way that they are right now. So they're kicking the tires. Warner Brothers and Paramount have been rumored to be talking to each other for a possible merger. We'll see where that goes later this year. But think about yourself. How many streaming services do you have? Do we all need 8 or 9 streaming services that we pay for? I don't think so. So you might see some consolidation on the streaming side as well.
And what will we see in terms of costs? Obviously, a lot of people followed Netflix's lead when it came to, more ad-supported tiers, cracking down on password sharing and things like that. How are those costs, do you think, going to get filtered through the streaming industry? And what are some of the other catalysts that you're looking at for this year?
Well, certainly the trend is for more ad-supported platforms out there. The streaming services are all doing it. Ironically, streaming was the place where you go to not have ads. Cable TV had ads everywhere. People started going to streaming. 2 major tent poles for streaming. Number 1, exclusive content you can't get anywhere else. And number 2, no advertising. And so people signed up for Netflix and other ones after that. But now it's changing. Every major streamer has or will soon have an ad-supported tier where the cost is lower. That's attractive for many consumers, but you're sitting through an ad experience. And then also on the exclusivity side, you have streaming services like Max, for example, licensing their content, which used to be exclusive to them, out to Netflix and others. That's new revenue for them. So, this is a world where they're paying more for actors, for directors, for writers, and so on. They have to make that money somewhere. So between advertising and licensing some of their exclusive content out to other platforms, they're trying to find a way to sort of, make the money back to pay for everything without having the consumer pay too much. Last year, we saw a lot of streaming services jack up their prices, and surprise, surprise, people pushed back and said, nope, I'm not going to pay this much more for the same streaming service. So that's really the push and pull that we're seeing right now between consumers and also these trillion-dollar companies that are trying to, be profitable.
Indeed, as we know, consumers trying to pull back on those purse strings, probably going to do a little reassessing of their subscriptions.
We don't need them all.
Should be doing. Exactly. Appreciate you joining me this morning, Gitesh Pandya, Box Office Guru, founder and editor. Thank you so much.
Great, thank you.
Well, Anjali Kemlani is bringing us all things healthcare from San Francisco. We'll share her interview with the CEO of Eli Lilly. That's next. Yahoo Finance's Anjali Khemlani has been covering all things healthcare from this year's JP Morgan Healthcare Conference in San Francisco. Earlier this morning, she spoke with Eli Lilly CEO Dave Ricks about the company's recent success. Take a listen.
We've been in this space a long time, as you mentioned. You said GLP-1s, but now we're actually adding other gut hormones, incretins we call them, together. So tirzepatide, which is Mounjaro, and Zepbound is two modes of action, GIP and GLP. And in the pipeline, we have another one coming with 3 modes of action. So you can see we're now learning how to exploit this biology to really affect a whole number of metabolic diseases. So last year was about the launch of Zepbound introduction. That happened in the fall, I think going well so far. Mounjaro had a great year as well in diabetes. Trulicity, our older product, continues to do well. This year, I think, will be about some of the new data releases as we study these drugs, not just to demonstrate they lose weight, which almost everybody loses weight, but what happens to your broader health. We're studying a population with congestive heart failure, a specific subtype called HFpEF, which is a partial ejection fraction. And that's really driven by obesity, so we're really anxious to get those results sometime in the second half. And then also a condition called sleep apnea, which is a common condition that almost 10 million Americans have, that we think we can reduce those signs and symptoms of sleep apnea by losing weight on tirzepatide. So this will be now the next step, to translate those health benefits with great weight loss.
Yeah, absolutely. Certainly something we're all looking at, right, is how much more can you get, what other diseases can get benefited by the work that you've been doing. I also know that you launched Lilly Direct. You're trying to get to the consumers. We saw how much of a run you had on just Mounjaro alone last year. These drugs are in high demand. You're running out at some points in the year. So launching Lilly Direct, getting to the consumer, directly to them with Zepbound first and then a couple other of your diabetes drugs. What is the goal? Are you trying to cut out the pharmacies and the PBMs here?
We're not trying to cut out anyone. We're happy to work with all those players. What we're trying to do is optimize the patient experience. And we listen carefully to the patients that want to use our drugs or are using our drugs. They're pretty frustrated with the state of U.S. healthcare and how it works for them. So we're trying, with Lilly Direct, trying to do 3 things. One is the direct part, which is get supplies or products from a manufacturer directly. That's an experience we all have in many parts of our life, and some people prefer it. I would say, in particular, people with obesity, who, when they go out into the world, are often shamed for the way they look. Many people don't consider obesity a health condition. They get blowback at the pharmacy counter, et cetera. So they, in particular, like the discretion of getting that product directly. Secondly, telehealth, which a lot of Americans had experience with in COVID, and some don't like, and some do. So here we're serving up a partner in different disease states, actually 3 different partners, who are good at telehealth, and people have a place to land to get that. And why do we do that? Because we've worked with them in various ways to make sure the quality of the programs are very high. And so Lilly can be a trusted source to get that telehealth provided.
Absolutely.
And then, I think the other thing I would say is, in particular with obesity, here again, patients report kind of doctor shopping to find someone who will write them what they know is a solution for their health problem. And so here it's just more convenient. It's not just, though, telehealth. We have a doctor finder tool on our site, so you can put in your zip code and find out who is a certified obesity specialist in your area. And access to healthcare and that knowledge gap with patients and the healthcare system is pretty vast in the U.S., so here's a way to bring that closer together.
Thanks to our very own Anjali Khemlani there for that interview. Let's get you a quick check of the markets as we head into the noon hour. Still looking at a mixed picture, looking at the Dow off, although easing some of those gains, still down about 82 points. Of course, still being weighed down by that Boeing news weighing on the Dow after its 737 MAX 9 jets were grounded by the FAA. S&P, though, still in the green by 0.5%. Tech-heavy NASDAQ leading the charge, up more than 1% so far this morning. That does it for me. I'm Rochelle Akufa, but stay with us on Yahoo Finance.